All right. Whoa, a little bit loud. Sorry about that, everyone. Good morning, everyone. Welcome. My name is Jeff Johnson, publisher of Minnesota Real Estate Journal. It's terrific to see so many people here live at the Radisson Blu today, as well as all of you joining us from home, from whether you're at your home or your office. And before we begin today's program and today's CE portion of today's program, I do want to make a couple quick announcements. First and foremost, for people that are watching from, for people that are watching from home, if you're having any connection problems, please, there's a red button on the top of your screen. What you need to do is just click reconnect, and if that doesn't work, just try it again. And if that fails to work, what you need to do is actually maybe hop off your screen and then try to log back on using another, using Google Chrome as our preferred email service, or web browser. So use Google Chrome if you're sitting at home as the preferred web browser today. We have about 100 people here that are going to be here live today, and about 150 people watching from home or the office. Also, very special thank you to our sponsors. Without these sponsors, it's impossible for us to make these programs work. So very special thanks to Bridgewater Bank, Colliers, Maxfield Research, Bellwether Enterprises, Bader Development, Michael Commercial, CBRE, JLL, Greystone, Ironmark, Marcus and Millichap, and the Multi-Housing Association. So please join me in a quick round of applause, whether you're here or at home. All right, so now let's begin today's CE portion of today's program, the 2020 Mid-Year Apartment Conference. This conference has been approved for 4 hours of a real estate continuing ed by the Minnesota Department of Commerce in the state of Minnesota. So if you're here today in person, on your tables, there's a sign-in sheet. So please fill that out today with print your name, sign your name, and then give us your license number. And if you don't have it, we probably have it for you, and we can fill that part in for you. Then Katie's going to be coming around shortly to pick those forms up. If you are at home, please type in the chat box your license number and your name in the chat box. And then every 2 hours at home, you need to be answering the CE questions in the chat box. So every 2 hours, 2 per hour, 2 per hour, you're going to be asked to answer CE questions. You have to, so a total of 8 CE questions today. If you're at home, you need to answer those questions. So it's very important for you to answer those. And then when you log out today, at the end at home, you're going to have to put your real estate license number in there again, as well as your name. And then in order to access the next portion of today's program at home, just go back to the lobby, which you'll find the lobby at rejournals.com/August 21 lobby. And if you're here in person, you can get access to the agenda at that lobby as well too, or just take a picture from your phone on the QR code. All right, so that was a very long introduction. I'm going to turn the microphone over to Keith Collins and his panel as they're going to be kicking us off today. Keith, it's all yours. Come on up and take it away. Wherever.
All right, good morning, everyone. Good morning to all the in-person people, as well as the online people that I can't see. It's certainly a much different vibe than it was back in January, but I'm glad everyone could show up this morning. Again, these are certainly challenging times for us. I hope everyone's staying healthy. These are challenging times for our apartment market as well. Although if one thing seems to be resonating right now is just how important housing is overall. And I think people are recognizing that. And we'll get an update just to see how our Twin Cities apartment market is doing with this panel up here. So why don't I just get it going here? I'll do some quick introductions. So to my far right, we have Matt Mullins. Matt is Vice President of Business Development, Maxfield Research and Consulting. Next to him, we have Steve Michael, President of Michael Commercial. To my left, Abe Roberts, sorry about that. I'm used to Abe, a different Abe. Vice President, again, for Marks and Millichap. And then to his left, Ted Bickle, Senior Vice President, Colliers. And then Josh Tallberg, Senior Vice President, Jones Lang LaSalle. So welcome. Thanks for everyone coming. What I wanted to do, just from an operational standpoint, I asked Matt to give us just an update, kind of just what we're seeing for operational trends. And, I think then, we'll get into more Q&A. So Matt, can you kick it off for us?
Yes, thanks, Keith. Well, good morning, everyone. Great to be out and about. It feels good to be out of the house for once. Back in January, we had this year-end meeting. We had, 1,000 people, I'm guessing? Yeah, it was a huge gathering, and it's really a tale of, 2 markets now to look back over the course of the past, 6 to 9 months. So looking over the course of the past year, what's happened in the multifamily market, really we had this, pre and post-pandemic market for most real estate product types. However, multifamily certainly has fared, very, very well in regards to all the various other property types. I think to set the stage, we got to look back where we were in early part of the year. We were sitting, we had record deliveries last year. Over 8,000 units were delivered in 2019. We had low unemployment rate, 3.1% first part of the year. We were projecting rather low vacancy rates throughout the course of the year. And we were predicting the economy to be pretty strong. I mean, albeit not quite as strong as 2019, but we were predicting a strong economy. Then COVID-19 hit us mid-March, stay-at-home mandates and whatnot. The market certainly turned like everything across the whole environment did. However, the multifamily market really has held up pretty well considering the current circumstances we're in. Looking at from an occupancy vacancy standpoint, again, we entered the year in the low 3s, about 3.5% vacancy rates. And as of right now, as of mid-year, we're still sitting pretty good. I mean, we're still sitting in that, 4.5% range as of today for stabilized properties. So we're feeling pretty good about where we're at today, considering what we could be. And I think a lot of that's contributed to the CARES Act, government intervention, at $600 per week that just expired. Certainly kept a lot of renters at bay, kept units occupied, and there were some eviction moratoriums in play as well. So, obviously renters could not leave the property due to the depending on how the property was financed. So things like that kept retention very strong. So there's been a huge emphasis on retention as turnover has been down. We've seen lease renewals have really been strong. And, despite the pandemic, even some of the new suburban product is still leasing very well. This past week, I was, talking to a few of our clients that are doing new deals. They're still hitting 10, 20 units per month leasing velocity for some of these new construction deals in the suburban communities, which is fantastic considering where we're at today. So there's still some good news out there in regards to leasing velocity. But we are seeing concessions, no question about it, especially in the urban core, specifically Minneapolis CBD and some of the neighborhoods in Minneapolis. Typically we're seeing 1 to 2 months free rent right now, pretty standard. In the suburban markets, we really haven't seen too many concessions yet. We're seeing, here and there, we might see a free month or something like that. But, I'd say urban core, we might see 2 months free. I've seen a couple of deals that were, sign an 18-month lease, we'll give you 6 months free. So that's the most I've seen thus far. out in the marketplace, which is a huge concession. But overall, I think the suburban market's faring very well. So looking at 2020, where we're at today. So we were predicting another record year for new deliveries. Again, 8,000 units were delivered last year. That was a record high. And we're predicting another, record boom in 2020. As a year, we're estimating approximately 11,000 units, like 11.3, give or take, for new construction. So a lot of new product coming online. And thus far, through first half of the year.
How much of that is urban versus suburban?
So a lot of that, great question, Keith. So we've had a huge shift. I know last year we were a lot suburban, right? This year, we've kind of gone back to urban. We're predicting the city of Minneapolis proper alone is going to have 45% of all new product this year. So by year end, we're predicting Minneapolis proper will have about 5,000 units come online. Hence, that has caused the the vacancy situation, concession situation in the city of Minneapolis. So we delivered about 5,000 units thus far mid-year. 2020, another 6,500 units in the pipeline to be delivered. And we really haven't seen too many construction delays. I mean, a few projects have been pushed back due to materials or construction holdups due to COVID or workers social distancing. And a lot of these holdups have almost been on purpose, so to speak, because they're kind of holding back delivery just to see how the market shakes out with new products. But we're not seeing too many construction delays out there right now. But we do see, it could be another 6,000 plus units delivered here in the rest of the year. And a lot of that's driven too by Hennepin County. Minneapolis, as I mentioned, 45% product. Hennepin County, we're predicting it's going to have roughly, almost 2/3 of all new product delivered this year. But we have seen a shift to, Dakota County's got a lot going on right now on new product in that submarket. So you're seeing some of those areas that traditionally have not had a lot of product have been ramping up. But overall, it's been we're predicting a record year, and with that being said, we will see some upticks in vacancy rates. I don't think it's going to be substantial, but we will see some upticks in vacancy rates. And a lot of it's going to be related to, can Congress get together and make a deal? We think that a second stimulus plan and another expansion of the CARES Act is really critical to keeping renters in place. So if they can strike a deal, we feel pretty positive about the marketplace and getting those rent collections in, because so far we've had really strong rent collections. Depending on the property, a lot of portfolios I'm looking over, they've been hitting 95% rent collection so far, which is phenomenal. It's absolutely phenomenal. But we have seen the slowdown in that by Class C properties, more affected by the job losses, retail hospitality components that don't have the financial means to make the rent. So the Class C is where we really see those rent collections being a challenge in the short term, especially if we don't get a deal in Congress for that stimulus.
As far as pipeline for next year, what do you project that's going to come out of line? Maybe comment a little bit urban, suburban. The other thing is obviously, we're seeing it on the brokerage front as well, just kind of the shift, suburban on the capital flow, but just maybe you could speak to a little bit kind of how the rent, how you're looking at rent growth for suburbs versus urban in the, next 6-12 months.
Yep. Yeah, Keith. So I think, looking at 2021 and beyond, we still have a lot in the pipeline. We're predicting about, 8,000, 8,500 units that are under construction today that could be delivered in 21. So another, strong year. However, we're seeing, again, the movement is kind of flip-flopping around between suburban, urban, suburban, urban. A little more suburban again next year. So that should take some pressure off, especially Minneapolis, which we need. But we're seeing, as far as rent growth, I think overall as a market across the metro area, will be flat, flat at best, maybe minus 1% as a whole. But looking at the areas where we see rent growth, I do think that we'll see positive numbers in suburban communities at the expense of more urban areas that will offer more concessions, have higher vacancy rates, and have some more pressure on rents. But we do see suburban holding up rather decent in the next year.
Thanks, Matt. I'll get the brokers involved now. Maybe Josh, I'll start with you. Kind of just maybe just general commentary, I guess. Just pre-COVID to kind of where we're at today. Maybe just kind of touch on. We can get in more specifics on the brokerage trends, but just what you're seeing, kind of operations, and where we're trending.
Am I on? Very good. So yeah, it's been an interesting, obviously, first half of 2020. We were joking. We had the big NMHC kickoff earlier in the year, and it was busy as it's ever been. Probably the largest amount of dry powder in the history of our space, looking for multi-acquisitions in 2020. And I think everyone probably said on this panel, 7 or so months ago, that this was going to be the highest volume year in the history of the Twin Cities. Obviously, it hasn't shaken out that way, but what we have seen, just from our perspective, being on the capital market side of the business, is really mid-March things paused for the most part. Deals that were moving forward were still getting done, but there was a large tranche of assets that literally there were properties that Friday where we were going to be sending an e-blast out to begin marketing, where we kind of hit the pause button. And I know everyone on this stage did the same. And obviously that was related directly to just the uncertainty of the environment. And that was from the brokerage side of it, the investor side of it. And what happened is we went in a period of a big pause in the marketplace. So really for a few months there, we had to stay at home. We were marketing still assets through that period, some of which actually tracked really well. But for the most part, the volume in the first part of the year was down 15%. In quarter 2, 2020, year over year, it was down 50+%. So things really went on a hold. As of late, and I speak for our team, and I'd say it's probably the same for everyone on this stage, we're the busiest we've ever been. So what's happening is through that period, the majority of investors took a step back, kind of looked at which asset classes were performing the best through this period, both on a macro standpoint, what cities were outperforming other cities across the country, and two things to the benefit of, again, everyone probably in this room. Multifamily has really separated itself, with industrial, of course, e-commerce, data centers, and I'd say life sciences, to be the assets that people are paying most attention to and are aggressively starting to deploy capital. And also core secondary markets across the country, like the Twin Cities, have held up far better than some of your higher priced gateway cities across the country due to our employment base, relative affordability. And those things have acted as somewhat of a boom for our market. And we expect that to lead to higher levels of volume here in the second part of the year. And in some cases, kind of cramming an entire year here in the next 3 months, as far as activity. So I'm sure everyone in this room is starting to see more listings hitting the market, and that's directly related to the fundamentals and just the performance of our market over the past few months.
Thanks, Ted. Maybe just again, I think what we're I've seen certainly just low interest rates certainly have seemed to trump some of the more conservative underwriting for our investors. Maybe you just kind of comment just kind of a little bit what you're seeing for pricing today. Maybe how it compared to kind of pre-COVID.
Yeah. Excuse me. So actually, we had a great anecdotal example. We did a valuation last winter, January, priced the portfolio, brought it to market over Memorial Day of this year, so post-COVID. Thought we were going out maybe a little bit early, but in the end, we had great response in terms of the number of offers. The buyer pool depth was the same or better than we would have expected previous to COVID, and the pricing was no different. I mean, I don't want to say there was a big delta or increase, but cap rate was about the same. If anything, interest rates have come down somewhat on the agency side, at least since then. So we saw really no change from where we would have expected pricing to be the previous winter. I think that's a testament to some of the things that Josh is saying too, that there's just so much money that's still allocated to multifamily. It's still sitting there. It hasn't been reallocated to other product types. And if anything, other product types, that capital might be finding its way towards housing. So I don't see pricing changing at all throughout the course of this year. Assuming there's not some other headwind that we're not seeing right now.
I notice, kind of tracking just collections. Obviously, MHA was doing the tracking, but again, not just Minneapolis, but all the Midwest markets, generally speaking, were holding up, better than nationally, for the several months, and I think that's kind of still the case today. So at least that's and again, I think the capital is looking at Minneapolis favorably because of that stability. Again, the Twin Cities as a whole, Minneapolis proper may have some other issues that we're dealing with, but again, long term, we hope and we think we'll be good on that front. Maybe if you want to just comment, just kind of what you're seeing. Just again, maybe I know you tend to focus a little bit more kind of that private capital, but at the same time, that private capital certainly is driving a lot of the values across the board. But again, if you want to speak a little bit to what you're seeing.
Yeah, good morning, everyone. Similar story to what Josh and Ted have spoken on so far. But when March first came around, definitely a lot of uncertainty in the marketplace. Deals that we had kind of ready to go out to the market went to complete halt. And for 4 to 6 weeks, there was just nothing doing. I mean, crickets. And then slowly but surely, people started regaining confidence. And then, we started seeing when one deal hit and people saw, oh, there's deals on market. And then there's, call for offers came and it closed. You started seeing more and more deals come through from there, kind of a domino effect. So, tremendous amount of uncertainty as we started off. But since then, I think in the last, the 5 deals or so we've done since COVID, 4 to 5 either hit list or went above list price. And one was, 98.5% of list. So that tells you the market's still very strong. The fundamentals in multifamily specifically, still very strong. People are looking for core assets, and it seemed to fare, along with industrial, it seemed to fare the best in commercial real estate.
And I've seen as well, just a couple Abe's point there, that they're also, it's still early, but I think people are thinking about 1031 exchanges and capital gains tax here in 2020. Maybe and if you have a property that you're looking to exchange, to do it this year versus after the election. So we have seen some of that exchange capital starting to flow as well within the market, and that, to Keith's point and Abe's, can directly drive not only the private capital space, but it can turn a private capital buyer into a competitor with any institutional group pretty quickly, depending on the size of the asset.
Yeah, I think you're seeing a lot of people. I think post once we get through COVID, where do you want to be? Retail, hotel. I mean, so I think people are thinking, apartments, industrial. That's where I want to be long term. And if I can put, and again, the next panel is going to talk about debt. So even some of the reserve requirements from the agencies they'll get into, but it's certainly accretive. And if you're a believer in multifamily long term, even if there's going to be some slow growth in the next couple of years, that's why I think you're seeing this aggressiveness. We're still seeing a lot of capital looking at it, albeit the institutional interest is moderated because they're so risk adverse right now. But it's a great opportunity for the private capital, and I think they're kind of taking advantage of that right now. Steve, maybe if you want to just comment trends you're seeing. You got a lot of stuff going on, not only in the Twin Cities but outstate, all over. Just a general commentary for you.
Thanks, Keith. I'm Steve Michael Commercial Real Estate. I was looking at this mask, and it's part of our life right now, but I will probably never be an accomplished mask wearer. I tried to eat ice cream with a mask the other day. Didn't go well. But yeah, as far as the market goes, what these guys said, I concur with that. We should be happy where we're at, because I mean, we just came through some pretty tough stuff. We're all still standing, and I think we're all actually advancing pretty quickly. The market is good. I think there'll be pent up demand next year will be even better. Just like these guys said, there's a wait and see in March and April, but that's all changed. We're all deal makers, sellers, buyers, brokers. We all like the action. And my recent experience is that we're back. Yesterday we closed on 77 units, 7-story building near the University of Minnesota, sub 5 cap. And the post-COVID action is just accelerating. We've got in March, we closed 145 units, 16 million in Bemidji. We did a portfolio in April in St. Cloud. Just recently, we put under contract 87 units in Baxter, 191 units in Baxter, 87 units in Hutchinson, and we've got over 500 units that's just recently gone up for sale in Mankato, Minnesota. And we just are going under contract this week, I think, with 353 units in Bismarck and Jamestown, North Dakota. It's here and it's back, and we should feel good about it, because we had some stuff thrown at us we'd never seen before. 2021, I think, will be a big year for all of us. The rates are a big part of that, and I think that's what's driving the part of the action here. In the November election, it's a wild card, but I don't think it'll be a crushing event for us either way, and specifically apartments. We're deal makers, and that American exceptionalism will show through, and we will still do deals. So I'm encouraged moving forward. There's more good signals than bad. Rents are low, likely stay low, pent up demand, occupancy high. We're in a good place.
Steve, with all that outstate activity, generally speaking, who's buying that? I mean, are they just private individuals? Are they syndicators? Just partnerships? Generally, who's the type of buyer for that?
Midwesterners, local, probably the North Dakota and outstate Minnesota. They probably live in the 5 states somewhere. The recent University of Minnesota 7-story building that closed yesterday, that was a West Coast buyer. But cost segregation is a big part of it. We have sold a lot, just cost segregation. Some people are earning big incomes out there, and they're covering it with cost segregation. So that's been a driving force in quite a few of our transactions.
Thanks. Yeah, the election, certainly is out there. It doesn't seem like that has a driver. I mean, it's people are concerned about, what does that mean for maybe capital gains? But at the same time, it doesn't seem like, we're sensing as a driver for sales. Maybe we can get into a little bit, and Matt, I've got a couple more questions for you, but we touched about the kind of the sale activity. Let's get into pricing a little bit. Steve touched on it, but Josh, maybe if you want to comment, kind of what does pricing look like, and maybe just kind of, I would say, like suburban core, urban core, maybe older value add, although value add is kind of hard to underwrite today, but just general commentary, and then I'll have the other brokers kind of opine on cap rates and values.
Yeah, it depends a lot on the asset. So to your point, that we marketed a few core assets, a few of which were kind of through the heart of COVID, and ultimately, the pricing pre to post COVID, what wasn't impact. I mean, it was nominal. I think maybe a few points as it relates to just year one underwriting standards. The yield requirements were largely still in line. Saw very little changes there. And as already mentioned on this panel, the debt is extremely attractive. If anything, it's better post-COVID. So that's helped offset maybe some of the year one and year two pullback as it relates to growth rates and maybe some concessions. But I will emphasize, that there are differences within not only assets but locations. So kind of true core real estate, predictable cash flows, high incomes. Those type of properties are obviously very predictable. People can put on long-term debt at very attractive rates. In a lot of cases, full IO for 7, 10, or 12 years, whether it's the agencies or the life companies. And that feels really good in today's market. Likewise, suburban assets are in some cases being priced even more aggressively post-COVID than pre-COVID. We've already seen somewhat of a trend pushing into the suburbs, especially some of these urban suburban locations. But we've submitted a few BOVs that we priced pre-COVID, and now we recently re-upped, and the pricing was actually a tad bit more aggressive. Assets where it's harder to predict the cash flows in the first few years, so hence maybe like a major value add type property, it's probably going to see a little pullback right now, just given the difficulty in underwriting that first 1 to 3 years in the value add. So when are you going to be able to get through the units, upgrade the units? What does that look like on the back end? But the assets where there's a predictable cash flow stream, and I would say even the neighborhoods in Minneapolis. I was talking to a manager the other day about a property. It's kind of a core neighborhood in Minneapolis, near the park, near the river, and the pre-leasing is just off the charts on that asset. So in certain micro locations, again, that's all going to relate to pricing, and with today's rates, it's been right in line with what we saw earlier this year.
Sound like a good salesman. You didn't. What are the cap rates? Show your hand.
From a cap rate perspective, I would say true core is you're still going to be in that, I'd say low to mid 4 cap from call it actuals to tier 1. You're basically going to price into a call it unlevered 6, which is going to give you levered returns in that low double digit yield, which again feels really good in today's marketplace. With a good B asset, you're probably going to be in that mid to upper 4 with, a trend for the first 3 years, probably getting into, I call it that low 5 cap range. And then I think the class C, depending on the value add, that's where it's going to range. So either you're going to be in that upper 4, low 5 cap with the potential to add value on the back end, or if it's more a middle of the fairway class C type product, you're probably going to see cap rates then in that called mid, maybe upper 5 cap, which provides an excellent yield in today's market because you can still get the agency debt at sub 3%.
Thanks, Josh. Certainly the value add, we are, people are still modeling it, but again, I think they're modeling it not in year one. It's kind of what we're sensing. Ted, just any general commentary what Josh shared on values? Are you on board with that or differ a little bit?
Yeah, mostly. And I think the key word that Josh uses predictability. I think you look at a lot of the uncertainty surrounding the economy generally and housing specifically, you haven't seen a big deterioration in operating statements over the course of COVID. There's more focus on collections, vacancy. Definitely moving forward, rent growth is being modeled more muted or flat for the course of the next year or two. But generally speaking, it's still seen as a safe harbor. I think in some respects, almost like a fixed income asset where you can really just capitalize on the spread between where your fixed interest rate is going to be on the debt side to buying a mid to low 5 cap. And I think that's really driving a lot of the pricing. But I think that's a very valid point that going forward, the thresholds, the return thresholds are going to have to compress because people are just being less aggressive for the first couple of years, say, in particularly on value add.
Abe, for like a 20 to 80 unit deal, what's kind of, what do the cap rates look like for that today?
Yeah, so thanks, Keith. So in some of the core markets, 20 to 80 unit, if there's a true value add story, we were seeing a lot of groups paying up on the value add side and the pro forma side, but they need to see a nice bump in it. So you're looking at probably 5.5 to 6, in getting to a 5.5 cap, whereas in some of the suburban markets, 5.75. A lot of that's based on debt. So you're talking in a $10+ million deal where debt's at 2.5, 2.75. Private capital, sub 5 million, or even 5 to 7 million. If you're going, unless you're going to Freddie small balance, but otherwise, your rates are probably not 3.5, 3.75 for 7 or 10-year debt. So probably in that 5.5 cap range.
And Abe, you're referring, I know a lot of that private capital space, it's an all-in cost type cap rate. So you might go into it at a 3.25 cap or something like that, but post value add, you're settling in that 5.5, 5.75 type range.
That's exactly right. So going in cap rates many times will be in the threes or 4s. That too, and call it 12 to 18 months. 5.5, 5.75, pretty good place to be at for some of the well-located assets, or class A locations. We'll see many times in the 5 to 5.25.
Obviously, there's a little bit more art in that smaller space, but at the same time, it's take advantage of those low interest rates. It's terrific. How about just again, we haven't had a lot of activity, but we are busy just like everyone else right now as far as selling deals, due diligence, but just generally commentary in the COVID world. How are you guys? Again, what we've seen is out-of-towners reluctant to come in for initial bids. They'll try to get best in final round. They'll find a way to hopefully get up here to tour. And then you've got kind of the lender DD requests. You've got the buyer DD requests, the site visits. Just let's, for the audience, maybe just kind of opine on the trends that we're seeing there. Ted, if you want to start.
Yeah, it's definitely changed. There's much more of a reliance on virtual tours. I think it is somewhat of an art now. I think the broker's job is to paint the picture of what the asset condition truly is and not oversell that. Because I think the buyers, especially on older assets, are relying on you to give them a very realistic picture of what their capital budget would look like going forward, and to just describe submarkets, immediate neighborhood areas, especially if they're not familiar with that particular location. So, I think that the broker's job has become more important over the course of this year as buyers are not traveling to town because they're really relying on you to help give them good advice. And we have a vested interest in making sure that when you do select a buyer, that buyer performs at the price specified and doesn't retrade. I think that does fall back on the broker too, and the owner's relying on that from the broker to make sure that everybody's being realistic from the get-go.
Yeah, a couple that. I would say it's amazing the technology we had at our fingertips that we really never fully utilized. But I know everyone on the stage now in their OMs. We're doing virtual tours, photos, floor plans, including as much information about the submarket as possible. And in a lot of cases, waiting until call like a best and final round until people are, jumping on a plane, getting approvals within their firms. In some cases, we've had groups driving 7, 8 hours into town to get in tour. We had a group just 2 weeks ago. They could only do day trips right now, so they had to drive. It's like 4.5 hours get into town. They saw about three different sites, and then at 5 o'clock on their way back, got home at 9, 10 o'clock, so made it within a day trip. But it's so people are getting creative. But I would say whereas we would have probably toured an asset 40 times pre-COVID, today maybe we're touring it 10 times. And then we're touring our 3 to 5 best and final groups once we get to that point in the process.
Any issues with the much experience with the DD? Obviously, you talked about the investor tours, but just any commentary on how that DD process is working?
Yeah, from our experience, we, as everyone, I think, had deals that we were under contract on at different stages going into COVID. Early on, it was pretty tricky, I would say, especially when we had the stay-at-home order in place. Just getting third parties through. We had a few properties, in fact, where we haven't had an opportunity to inspect the buildings yet. So in essence, we had to keep extending so we could finally just get through the building. So the buyers could see the units and do their full inspection. Fast forward today, the agencies have done a really good job getting things streamlined. We just had an appraiser through a building earlier this week. And now because we can tour assets, see real estate, and utilize boots on the ground whenever possible, things are much more streamlined and the processes feel very efficient. Title companies have also done a really good job, I think, keeping things moving forward, despite everything going on.
Just a show of hands here. Who their offices are open on the stage here? Wow. Ours is not. So that's actually pretty good. So anyway, that's interesting. Matt, I would be curious, just maybe just general commentary on kind of the demographic trends that we're seeing out there that we really should be, conscientious, kind of in this COVID environment, and then, trending. The other thing is just now it's good that some of these people are saying they're working, they're going to work again in their office buildings, but I know a lot of people still are not, like myself. How long is this going to take to get some of that vibrancy, those amenities, et cetera? You think, is it a vaccine, or what's kind of your take on that?
Thanks, Keith. So I'll touch on your first question first, demographic trends. So certainly, back to vacancy, we'll touch on that. Some of the uptick in vacancies has been in the studio units, smaller, unit sizes, and people rent these units for a reason: proximity to amenities, right? To be downtown, and downtown for the most part is pretty much shut down. I mean, 10 to 15% occupancy rate in the office space right now downtown. You can't go to the ballpark, theater, whatnot, restaurants. So the appetite for some of those units has waned short term, but long term, it's certainly going to come back once things get back rolling like a normal economy would. So short term, we're certainly seeing more shared situations like roommates. Demand for 2 bedrooms, 3 bedrooms is strong right now. We're also seeing that desire for more of a separate entrance type unit. So whether it be a townhome, row home style, single family rentals are hot, especially, this Twin Cities market, we really do not have a built for rent single family development. We have the new project in Maple Grove I just traded this past 2-3 months, I believe. But nationwide, there's a huge push for built for rent single family, targeted families, and more of a luxury product as well. But just in Twin Cities here, it's just been tougher due to land costs and government regulations and whatnot. But we still see really strong, demand for that product type. But I think from a design standpoint, we're going to see some really unique things come out going forward. As architects repurpose buildings and new designs for the demand for office, home office use is going to be high. I mean, we're predicting. Most companies are probably not going back to work in 2020, at least from people I'm talking to, if not even into, spring or summer 2021. So we've got a little, upwards of 9 months potentially ahead of us for the stay at home, working from home, which puts more demand on, buildings that have the ability to, have flex space, workspace, as well as units that have the ability to, have that designated workspace. And the reality is today, everyone can work on a laptop and a cell phone. So we don't need a huge square footage allocation to home office use. But we do need to have some area that people can, feel settled, have, noise is a big one, to reduce the noise levels. That's one of the key drivers as well. So the second question, Keith, was, right. The second
When do
question
you think
is-
this is gonna,
Right.
change? And I put you really on the spot. Is it a vaccine or antiviral?
Right.
But I know it's a tough question. No one really knows. But
I think it's anyone's guessing game right now, right? We all think we're experts, but no one really knows. But certainly the vaccine is going to be the huge driver here. Most economists say that the economy cannot fully rebound until we have some sort of healthcare vaccine in place to mitigate the spread of the virus. So, is that late 2020, early 2021? But we do see, multifamily housing and housing specifically, as well as other brokers kind of on industrial and e-commerce as being, the preferred real estate asset classes. Multifamily sits at the top for recovery. We do see the multifamily industry, more of the, I don't know if you want to call it a V or not. I think the overall economy is going to be that Nike swoosh that we keep talking about. But multifamily, I think, has potential to bounce back much faster than most other product types. So I do feel pretty positive about the multifamily industry.
how about just general commentary, affordable housing, affordable, and I guess, workforce housing, and, some of that, it just seems like, if you build kind of more of that just middle of the road product, the demand there is just off the charts. There's a deal. I'm looking at a guy right in the front table here that had a 4-month lease up on a deal in South Metro, and that's hitting the spot. And so it's just unbelievable if you build the right product today, what that demand is. But just general commentary on kind of just affordable housing, workforce housing.
Yeah, no question, Keith. This year, I mentioned of that, it was 11,000 plus units. About almost 20% are affordable. So it certainly had a more affordable housing production here in the metro area. However, still not keeping up with demand, as we know there's such strong need for that type of product. But I agree, the sweet spot have been saying for years now has been, how do we build a market rate product that does not have $250 per square foot rents, that's still market rate and not age restricted? Can we build a market rate deal that's $140, $150 per square foot? That middle income, we call it the middle market, so to speak, is a sweet spot. We can do it all day long, but due to a variety of factors with land costs, construction costs, government regulations, labor, materials, you name it, it's been challenging. But if we can do a bare bones market rate product, I think there's demand all day. And I also see strong demand. As we leave the Twin Cities, communities across the state, across the Midwest for that matter, those 10, 12, 15,000 person communities, strong pent up demand. If you go to, Hutchinson the other day, a couple deals going on there. Strong demand. Lease up was phenomenal. There's cranking them out. I mean, they'll be at basically 100% pre-lease on a couple of these new deals right now. But a lot of these towns in that 10, 15,000 person population, hitting those rents that are $120, $125, $130 a square foot. There's certainly pent up demand. So we see strong demand in those markets. And the reality is that they haven't been hit by COVID as hard as the metro area. When I go to these communities, I was all across central Minnesota yesterday. You never know if COVID hit, right? It's like it was completely open. So the economies have fared pretty well, and there's still real strong demand. A lot of those more rural communities across the state.
Steve, you have any comments? Just again, you touched on a little bit of that kind of outstate markets. I know we talked about Brainerd earlier. you and I just, and I think it's a good point, but just kind of where that workforce affordable checks out in kind of those markets.
This is all about apartments, and apartments are going to go strong in outstate Minnesota, and be strong. These cities that have a college, have a hospital, are the county seat, buy in those cities. Those cities will be there for the long term, and lenders are more than happy to lend in those cities. And so I would say that if you're not finding what you are hoping to find here in the metro, first, second, or third tier suburbs, give me a call. So as far as affordable, that is going to be something that's tough to address for a while in a lot of instances, just because of the cost of construction doesn't generally go down, and the cost of land doesn't generally go down. So the affordable product's still going to be hard to put on the market. But there's some people who are really successful at it. And I mean, there's guys sitting in this room right now that are really successful at doing both market rate and apartments. But I guess long term, Keith, just a 30,000 foot view, apartments are going to be good outstate Minnesota, if that was the original question. And I'm looking out here right now, and some guys are going to make it happen no matter what. I mean, there's Frank Lang here, and there's Kent Roars, and there's Chris Sherman. I mean, these guys will make it happen. We will adapt no matter if there's a vaccine or there's not a vaccine, and we will build apartments and sell apartments and trade apartments, and it's going to keep going. It's a basic need, and hang on, because I think 2021 is going to be big.
Thanks. And maybe that is a little segue. Let's kind of talk about just what the outlook is like, on I guess value trends, volume trends. Again, it seems like obviously this year is going to be down, but it does seem like it's going to be a strong finish, I guess. But let's get some commentary on that. Abe, I don't know if you want to start on that.
Yeah, I'll jump in. Yeah, kind of like some of the brokers already mentioned. I think the second half of the year is going to be really strong. We're starting to see that already. More and more proposals coming through and VOVs. And I think that's only going to continue to increase, especially as we get close to the presidency. I think Josh was mentioned earlier too about the potentially, the 1031 exchange clause. I know that's been in the talks many times in the past too, and it's never passed Congress. But that is creating a lot of frustration amongst owners, and many of them are looking to take advantage now, while they know it's still there for us to use. So I think the rest of this year is going to be very busy. It's going to go into next year, and generally speaking, very positive outlook. I know there was a lot of uncertainty throughout. I kind of laugh because March, April, May, June, and July, almost month after month, talking to owners in the industry, everyone's saying, yeah, this, kind of doom and gloom, right? So this month we were fine, but next month it's going to be horrible. And then the next month comes and it's, it was fine this month, but next month is, that's really what's going to hit. And it literally went on for 5 months. And look at us now. So multifamily has done extremely well. I think it's going to continue to perform and outperform any other asset type. So,
Ted, and again, just if you want to continue to opine on that, but again, as far as underwriting, I mean, do you think there's going to be concern about, obviously we've been stimulating the economy, hopefully, continue to do that, but what is the toll going to be? How concerned are we? Property taxes, obviously they're high right now, but the budget deficits now, people are going to be needing to find more money. So again, when we look at that, is that something, are we concerned about that much, or do you think we can override that with, again, everything we've talked about?
I think the real estate tax question is very valid, and I think there's more concern that with pickup and sales volume that those tax bases will increase. I mean, I think buyer underwriting historically, though, at least over the past couple of years, they'll assume taxes get marked to 90 to 100% of the trade value. And I think we were discussing last week on our pre-panel call that, what if that turns into 110% or 115% of the expected trade price? That would have a major impact on pricing. So that's something we'll certainly be watching closely. On the front of just general underwriting, though, I don't see, aside from just muted assumptions on rent growth going into next year, I really don't see much else changing. I think cap rates are about as low as they can go, given that interest rates are where they are. And again, like the buyers are capitalizing on that spread. But maybe something that I would have pitched as a value add last year or even early this year, now we're reorienting and saying, well, maybe it's not a value add for the first couple of years, but it's a great cash flow deal. And going back to the stability factor, I think that's very appealing to a lot of buyers to say, hey, this is a way to lock in long-term debt at a decent cap rate. Really don't have many concerns about where our cash flow is going to be going forward if we don't institute that value add plan and just kind of stick to running on a cash flow basis. I still think that for the most part, we've weathered the storm through the spring and early parts of summer very well. And yeah, just to Abe's point, that got tiring over the course of the spring and summer where everyone says the next month's going to be the cliff where collections drop to 70% or vacancy pops up to 10%. And that's happened in certain areas of the Twin Cities. But for the most part, I've been very surprised and very happy that we've rebounded so quickly.
Well, I think it's also been a tale of the Twin Cities. So there are obviously cities across the country that are seeing collections a lot less, more your transient type cities, where the Twin Cities tends to be a very sticky city. People are, it's more affordable, and our employers have, for the most part, been doing very well. I mean, Target this week reported 25% increase in sales year over year, close to 200% in their e-commerce division. If you go to their website, they're hiring engineers. They're ramping up. Cargill, United Health, Optum, having that big employment base, which oftentimes isn't extremely exciting when you see the flashy WeWorks of the world growing, and you're hearing it all over the news. But at times like these, those businesses feel really good.
So where are the best opportunities, you think, right now? I mean, again, I know people are looking at pre-stabilized deals, the right deal. Now that's a little, maybe in the burbs. But if you get the right deal, TOD used to be hot. Now it's maybe not. But where do you see the best opportunities, going, into this, fall and next year? Josh, you want to start?
Yeah, I think suburban, if you can find the right assets right now, are continue to be extremely attractive. There are certain supply constraints in the Twin Cities suburbs as it relates to zoning. We touched on it earlier, just pure construction costs. So if you can find the asset that is accessible, affordable at a price point, that there's high barriers to entry that in essence creates an economic moat, if you will, around a lot of those cities and a lot of those assets within the suburbs. I think from a long-term perspective, some more your core plus capital, the urban areas are, in our opinion, extremely interesting. People still want that vibrancy. Yes, today even the CBDs, it's quieter, but it'll come back. Everything we're seeing on the ground, people still want that lifestyle. And when you look at replacement costs and just, again, the barriers to entry to deliver, call it a core downtown building in today's market, now with inclusionary zoning and just some of the regulation and restrictions, the supply and demand fundamentals, maybe the next 6 to 12 months will be a little soft, but put that 3, 5, 7 years from now, those assets seem really interesting. And I think development's also one that we're seeing a lot of equity kind of pushing into that space. People like the idea of, building a building post-COVID in 2021, 2022, and taking the current uncertainty off the table.
I've heard that. So if we build it right now, it's going to take us a couple of years to build. So once we open up, everything will be good. And you're right. I think Minneapolis, it's certain to get. There's a caution flag, but at the same time, it's got the infrastructure. It's got the we'll have the amenities when they open up again. And so maybe it's a little bit more contrarian right now. Maybe that could be opportunistic as well in the right thought process. But Ted, your thoughts?
I'd agree with that. I think if you're a Minneapolis buyer long term, this is a great opportunity to be opportunistic and jump in and buy something that almost certainly is trading at somewhat of a discount. Because I believe long term Minneapolis will rebound, things will calm. I mean, maybe it's not a year, maybe it's a couple of years, but I think buying Minneapolis is a good opportunity right now. Probably St. Paul too, proper. Third ring suburbs, I think that's another area that I'll watch closely. If telecommuting and remote working, even on a part-time basis, ends up being a permanent economic change unrelated to the pandemic, I could see future tenants, maybe not people that are currently living in, say, a first ring suburb or Minneapolis, moving out to Shakopee or Chaska or Hastings, but a tenant that says, well, I don't need to go to commute into town 5 days a week, maybe it's 2 days a week, or it's on off hours. Maybe they'll stay out in Lakeville or a city like that, get a bigger unit with an office or a den or something like that to remote work because they want to stay in maybe their hometown, or they have a spouse that works in the area, or they've got pets or children, or they're planning on having children. I could see it becoming more a model where it's attractive to live in those types of locations because you're not always focused on what your commute looks like each morning, if that ends up being a permanent change.
That makes sense. I definitely think there's an opportunity there. It's interesting when we had an office broker from CB talked about Manhattan and just about, why Manhattan will recover just because it's a culture thing, and it's people want to be in Manhattan just because it's who I want to be seen. I want to be where the action is. Well, we're in Minnesota. I don't think so. There might be some similarities, but at the same time, I think to your point, there's plenty of demand that people don't have to be where the action always is. And so that speaks well to kind of those outlying areas.
And maybe they recognize that too. They lived in Uptown and they find that they moved home with their parents. And I like being able to walk to a corner store or something in a smaller city like Hastings. I don't need to be next to all the bars in Uptown because obviously everything will open up at some point. But the value of being at Main and Main downtown might decrease to some extent, and they'll find that they like living in some of these suburban nodes more, or at least relatively speaking, based on the price.
Abe, anything you have?
Yeah, I mean, while the general trend is definitely heading to the suburban markets, seeing more and more people who have portfolios and built up their whole businesses in Minneapolis proper or St. Paul proper, and are looking to exchange those assets into some of the suburban markets. So you're right, that is definitely a trend we're seeing, and that's driving cap rates down as well. But at the same time, not really seeing much of an opportunity, so to speak, in Minneapolis or St. Paul to buy. We're definitely seeing some buyers kind of fall on the wayside and drop out, and whether it's lack of interest because some of the city ordinances or whatever it may be, or COVID-19. So there are definitely some of those buyers, but in general, the listings we're bringing out, the logical buyers for that asset are still very engaged. And so that's in place, and as well as kind of a new smaller pool, but a new pool of a kind of newer buyers, newer syndications, which are looking to get in, thinking that it is actually a good opportunity. And so there may be some opportunity there, but I don't see it as a huge opportunistic, buy in Minneapolis at a discount.
Thanks. Ted, back to you. And I guess we really didn't talk about a little bit of the capital just that is buying right now. Just any general commentary that you can opine on as far as kind of is it the same capital that's looking, showing up on these buyer lists, or has it changed at all?
It has changed even through the course of this year, and I was expecting that we'd have the same buyer pool as previous years, but I'd say, just as in years past, anywhere from 10 to 30% of the bidders are new buyers to the metro that don't own property here currently. Maybe they've bid on properties in the past, but they still don't have holdings here. And we've, at least from the last couple months, I have seen a stronger push from groups that are here and have struggled to really grow a critical mass. So they might own a couple hundred units and they're really trying to get 1,000 plus. I've seen a strong push there to say, hey, we are buying our second, third, fourth deal here. It's going to be this year or 2021. So I have not seen any exodus in terms of buyers that are non-Minnesota based looking at properties in the metro area.
Thanks, Steve. Any just opportunities that you see, challenges maybe that are out there as well?
Yeah, Keith, thank you. I'll just say one thing. Rates are so low. If you find a building that makes some economic sense and it comes close to your buying criteria, doesn't matter where it is, first, second, third suburb, outstate, buy it.
Steve Michael. Matt, maybe just because I think we're kind of up on time or close to it. I guess I would just, you touch on some of this a little bit, maybe kind of with modest development product, but where do you see the opportunities in the apartment sector right now going forward, this fall and going into next year?
Well, I echo a lot of these comments from the brokers here about the suburban versus urban. But yeah, I think, certainly we feel pretty positive about the market considering what we've been through the past 6 months. We're on solid footing. We think multifamily is going to be, a great asset going forward. And, a lot of the comments about low rates and capital, I think it's still a great place to be. But yeah, opportunities, we talked about affordable housing, workforce housing. We see demand in, family-based housing, that little larger unit sizes. Again, we talked single family rentals, townhome rentals. There's still a lot of demand out there. I just think the way buildings are configured may change, from architectural standpoint, for a little more less touch point, just, more smart home technology, things of that nature to help make these buildings more healthy, because there's a huge push on the whole healthy living, cleanliness, and just that lifestyle change. But I do think we're going to see more people certainly working from home, telecommuting, maybe be part-time, full-time, I don't know. But that is going to have an impact on locations, and that's why we do see that suburban product type and outstate Minnesota product type being very favorable, just due to that ability to really, you can live anywhere today. You don't need to be next door to your employer. So that is going to open up a lot of opportunities across the metro and the state.
All right. Well, I think our time is up. Is that correct, Todd or Jeff? I don't know if we have any. Okay. Questions, but I think we got to go. So Jeff, you're going to do the baton toss. All right. Well, thanks, panelists. I appreciate all your commentary.
All right. Thank you, everyone. So if you are watching from home, please log out of this webinar, go back to the lobby, and then come back in. You'll click on the 9:10 segment to come back in. Otherwise, please join us back on the excuse me, here, let me pull up my agenda here. 1 second. I just had it here. I'm going to hang tight. All right, so this actually works when you use a QR code. All right, so on to our next segment. So we are going to be doing, our next segment is, whoops, hang on 1 second. is our financing panel. All right, here we go. So Marcia Goff, sorry about that. I should have had this prepared when I came up on stage, but anyways, Marcia Goff is Executive Vice President with Merchants Capital. Marcia, it's all yours. Take it away and the rest of the panel.
Like home, I need my son to help me. He's like, Mom. So good morning, everybody. We are happy to be here, talk about the capital markets for multifamily. Oh, I need to be closer. Sorry about that. For those of you who listened to the last week's Real Estate Journal session, there was a lot of talk about capital markets, and they touched on multifamily. We'll take a little bit deeper insight into multifamily and talk about the different asset classes and really what we're seeing in the market and any impacts on financing. The good news is the financing is still relatively stable and strong, and but there have been changes, obviously, and we'll talk about those changes. So again, I am Marcia Goff with Merchants Capital. We do have a parent company called Merchants Bank. So we do both construction lending and then bridge lending, and then also the primarily the GSE and HUD takeouts. We also do rural housing. For smaller markets, we are in the rural housing loan product as well. So I'm going to have each person on the panel introduce themselves. So I will take it away.
Good morning. My name is Nick Place. I'm with Bridgewater Bank. We are a local community bank founded and located here in the Twin Cities, right around $2.7 billion in assets. Our loan portfolio is around $2 billion, almost exclusively Twin Cities-based commercial real estate assets, with apartments making up roughly 25% of our portfolio. A big portion of our apartment book is in the Class C and B space, and we do quite a bit of construction lending here locally as well. Most of our transactions are in the sort of anywhere from 20 to 150 units is where we tend to do most of our business.
Good morning. My name is Kyle Gemtrude. I am managing director and run the Minnesota office for Greystone. Greystone is a national multifamily lender. We have every Fannie Mae, Freddie Mac, and HUD program available. We have a balance sheet pre-COVID, provide equity, mezzanine, focus 100% on multifamily.
Thanks, Kyle. Good morning. I'm Nate Podratz. I work with Mortenson. I sit on the development side of Mortenson, which, for those that aren't familiar, is about almost a 70-year-old privately held third-generation family-owned business. The development company has been in existence for about a little over 35 years. Our focus is about a half dozen markets across the U.S., major Midwest, Pac Northwest, Denver, Phoenix areas. We have development areas of focus that include residential, medical properties, office, industrial, and even hospitality. Going into COVID, we were, I think, about a top 5 hotel developer in the U.S. Fortunately, a lot of that exposure was really more fee for service, not operational, although we did have the fortunate timing of trading out of close to a $300 million hotel at the end of 2019. So happy that I'm not working through that right now, but we're pretty active right now despite challenging market conditions. We even closed and started a hotel down in Phoenix a couple months ago. partnering with an owner operator that can take a long-term view. So we're continuing to focus on opportunities, trying to be patient at the same time, but want to be aggressive where we see there to be good long-term opportunities.
Good morning. I'm Annie Sager with, can you hear that?
Yeah.
With Bellwether Enterprise. We're based in downtown Minneapolis. Our headquarters are in Cleveland. And we're a national mortgage banking platform, Fannie, Freddie, FHA, and then a lot of life company business. So we source debt and equity nationally. And then here in Minneapolis, we obviously focus on the Midwest. So the bulk of my last few months has been a lot more triage relative to pandemic-related loans based on our servicing portfolio. But similar to what these guys are saying, we're still really active and doing a lot of good new refis and new development business based on, taking a long-term outlook as well. So thanks for being here.
I really need to work on my intro. Apparently, you guys killed it.
Thank you, guys. So we're going to start with what you guys are seeing in the multifamily rental market, because obviously the trends will impact credit impacts pricing, and then the financing. So one of the, we all are watching what's going on in the market. We're looking at our own servicing portfolios. So want to talk to you what you're seeing among trends in your servicing portfolio, as well as deals that you're seeing come in new for quotes in terms of rent collections, rent increases and or concessions, and then absorption for recently completed products, especially if there's any differences COVID, versus pre-COVID and what you're seeing. So I will start off with you. I guess, Kyle, we'll start with you.
All right, I'm shocked by that, but so what we're seeing nationally is that Class A has been softening. There's been higher vacancies. There's been more concessions. There's just been such an oversupply of Class A in the market. We're seeing that also on the construction side of things, where we've looked at markets from Louisville to Oakland to Dayton, Ohio, and there's just not a demand for building new Class A. I mean, we're seeing negative 6,000 unit demand over the next 3 to 5 years in multiple markets. So we're definitely seeing a slowdown there. B and C still remains strong. There's a huge demand, pent-up demand for workforce housing, as there has been and probably will be for a very long time. So we're seeing strength there. And from a value add perspective, that's kind of a hard thing to do right now in the midst of a global pandemic. It's hard. People aren't necessarily moving. I mean, we're seeing in our portfolio and some of the stuff that we've done here locally that people are reducing their rents. Fannie Mae, the Fannie Mae chief economist sees that rent is going to be stagnant, rent growth is going to be stagnant or possibly declining over the next 18 to 24 months. So I think we're going to kind of taper off a little bit here over the next couple of years and maybe flatten out. And that's kind of what we're seeing. We're not seeing a lot of forbearance requests out of my couple hundred loans in my portfolio. I have 4 company-wide. We're at 3.2% of our $40 billion portfolio is requested forbearance. So I think rent collections are still good. People are still finding a way to pay, but we'll see what happens as the federal unemployment tapers off, and we'll see what happens as this pandemic goes on.
Nate, what about you? I know that you said you do a lot of local products, and so are you seeing any differences from the national side as well for rent collections, et cetera?
Yeah, I mean, we were concerned in March, as a lot of folks were, with how rent collections would come in. I think, as the prior panel discussed, we were very pleasantly surprised as we were discussing with our borrowers that their rent collections were, much better than they had thought, or that going into this. We did receive, and we've got a very diverse commercial real estate portfolio, which spans, all the asset classes. Roughly 20% of our book requested some form of modification, and so that's across all asset classes. However, there were only a handful of our multifamily transactions that requested any sort of payment relief. The bulk of that was just looking to do some modifications from P&I payments to interest only to, stockpile some liquidity to weather the storm. And really, in all of those cases, it was just precautionary and not really, as we thought, even going into it. And then as we now have the benefit of looking back, was really necessary. But we've been pleased to see that the bulk of our borrowers' portfolios have seen rent collection, as the previous panel mentioned, in the mid 90% range, which we were very happy to see. As Kyle mentioned, it's really difficult to get a good sense of how consistent that will be on a go-forward basis. I think we are cautious about, is that a trend that is just due to the strength of, the multifamily market, and specifically the Twin Cities multifamily market? I mean, we're a bunch of Midwesterners that pay their debts, right? So I think that has helped rent collections, but $4 trillion worth of economic stimulus doesn't hurt either. So and an extra $600 a week in unemployment benefits, I think there's a lot of positive things that we're pushing that along. As these sorts of stimulus plans taper and there's uncertainty to what it will look like going forward, we're cautiously optimistic and continue to monitor our portfolio to see how it performs. But local sponsors are generally pretty cautious. They're generally, not high flyers over levering their portfolios. There's always some of that in every market, but across the board, we've got a good ownership base here with long-term views. So we feel really confident about how it'll perform long-term, but we are certainly being a bit cautious, over the next 12 months.
Thanks. Amy, I'm going to just ask you one question about asset classes. So I know we touched on luxury market rate and the rent concessions and the demand for that. If you read a lot, you start seeing that affordable housing has remained strong in collections. And then though we've heard that workforce housing and or Class C apartments may be stressed. And I think that's a trend we're starting to see more in the press. Now, whether or not we're seeing that is true. What's your opinion on that?
Yeah, so I would echo a little bit of what Nick said too about rent collections in general, that everyone's been pleasantly surprised, at least with apartments. I mean, obviously retail, hospitality, some of those other less stable over the last, 10 years or so asset classes have had a harder time with collections not being able to be open. But on the apartment side, I think, the overall, especially on the lower end side of things, I know seniors housing collections has been like in the 90%, at least what I've seen, and because those people are used to their fixed income and they can weather this. Same with the Class A stuff. While I think that's softening a little bit, we're seeing, those folks have had the ability to work from home, and that's been huge. And so that's one of the reasons we're seeing on the, maybe B, C stuff, a lot of that is essential workers or people that have a little bit more volatility in their income. And so those collections have been lower from what I've seen, but I haven't seen anything that's been crazy startling. I know some of that's starting to come into the media. And again, we're still, to be honest, we're still in the very early parts of the fallout from all of this. This could be, spanning the next 12 plus months, but I haven't seen anything lower than even in the mid 80s right now for some of that kind of BC stuff. So overall, I think it's been really positive. But again, I think, like Nick said, time will tell to see if this is just a current trend or if this is going to continue for the next, or till the pandemic ends.
Great, thank you. So I think, we continue to monitor collections, look closely at the trends going on the market, but relatively it's been stable and not as, I think, severe as initially thought in, March and April. So we continue to watch that.
I think, Marcia, if I could add just a couple points.
Oh, sure.
I think, going into this, we were seeing, cost escalation on the construction side, rent growth that wasn't maintaining that pace. And so last 2 or 3 years, for better, for worse, we took our foot off the gas a little bit in the residential category because we tried to hold the line on risk premium and tried not to chase, down the rabbit hole of, 5, caps on development deals in cities like Seattle, which were getting done, banking on a 3.5, 375 exit, which was just really hard to justify. But I think, what we're seeing in our small portfolio isn't really an issue with rent collections, but the notice to vacate are concerning. The run rate this year, especially for our urban infill assets, is higher than we've ever seen. So the stickiness of the suburbanization sort of trend out of the urban markets is concerning. Something to keep an eye on. Hopefully that stabilizes as we get through the election and hopefully into some better days ahead of us with the virus.
Thanks, Nate. That's an important point. And I think, again, it just shows that as lenders, we're continuing to watch all the trends and taking a look and assess the risk. So each deal is a little bit different depending on the characteristics. The next question I'm going to ask really has to do with, there's been a lot of attention on forbearance. I can tell you from the GSE side, HUD side, I swear there's a new guidance coming out weekly on forbearance. So Kyle, you had said that you hadn't seen much forbearance, and I know from our company, we primarily do 100% multifamily across all asset types, and they've had one forbearance request, and it's a balance sheet loan, which is, it's nominal, nothing. And it was surprising because when the first came out, everybody was concerned about this. So I guess maybe just give an update on what you're seeing with forbearance request, and then also maybe how the life company is handling it different than the GSEs. So Amy, you want to start with you?
Yeah, I think as it relates to forbearance requests, obviously the onslaught of that came in kind of March, April, May. And it was right away pretty apparent that the GSEs are able to put more of kind of blanket regulations out, just being that that's how they can operate. The government was responding with stimulus. And I know that changes a lot, but they can kind of do an across the board approach, whereas the life companies are so individualized to each asset and their own investment strategy and plan that's taken a lot longer for them to come out with guidance. So that's more for industrial, retail, hospitality, other asset types besides apartments. And I think for the most part, we didn't see very many forbearance requests for apartments on the life company side, but for requests like Nick was saying, for interest only, just to start stockpiling some liquidity and cash to, weather the storm, going forward in the next 12 months or so. But for the most part, it's been a, pretty arduous process for other asset types. So people with apartments, in general, I think are pretty happy with where things are at right now relative to where they might be across other assets in their portfolio, because those responses and trying to figure it out with the life companies on an individual basis on each individual loan has been a little bit more difficult. But it's been going better now, and they've been able to respond to most loans and look at kind of the next 3 to 6 months at least. And we could be repeating this process again in 6 months once that initial time frame is up. But I think we're through the first part of the storm, which was a huge hump to get over.
Great, thanks. Nick or Nate, do you guys have any other items you want to add to forbearance or any trends that you're seeing?
Well, I think, early on, there was just so much uncertainty. I think a lot of it was just, borrowers trying to be prudent with managing their cash flow and their assets. So I think, and obviously we then saw, a complete shutdown of the economy, both locally and largely nationally, unless you're South Dakota. But I personally don't expect that to revert back to where we had been before. So I think, those folks that were just being cautious on the front end, as we've come toward, the end of, in some cases, these modifications that we have provided, we're reaching out to those clients and having discussions with them if they feel like they're going to need further, sort of assistance. And, the bulk of those clients, roughly 80%, this is just across our asset classes. So multifamily wouldn't really fall into this too much, but are saying that they don't believe that they will. They think that they can revert back to the full payment schedule that they had before. So, which is encouraging to see as the economy is starting to very slowly come back to life. We're all sitting in a room here. I think, 90 days ago, that seemed like something that would never happen again. So I'm optimistic that, we're through the bulk of the sort of modification requests that we would expect to have seen, and are hopeful that we don't need to do much more of it.
So on the front end of when March, when the pandemic really hit and forbearance hit the market, We were, as a company, were fearful of an onslaught of forbearance requests. And how the GSEs work, especially Fannie Mae, is that in a forbearance situation, we as the servicer are responsible for still making those payments on behalf of the borrower to the investor that we sold the bond to. So that was scary for us with a $40 billion portfolio, and 20 something billion dollars of that happens to be Fannie Mae. So if we had an onslaught of people that were unable to make those payments, Greystone would have to have the liquidity available to make those payments on their behalf. And so as a result, we pulled back very hard from balance sheet lending, providing equity, mezzanine, anything that was our own money. And in the last 30 days or so, we've started to roll balance sheet lending back out in select markets and for select sponsors. So I think from our company's perspective, things are starting to get better, and we think we're reaching the end of the risk for forbearance.
I think, Marcia, from our perspective going into this, we had structured our debt pretty well just in terms of leverage levels, and we had been accumulating reserves at I'd say a higher than market level. So we've had some cushion going into this, and so those attributes have been nice. But I think the best thing for us has really been our relationship banks, and the relationships have really come to bear in a market like this. I'm worried a little bit about regulators and whether risk ratings will come into effect here. I think reserves are happening, but the regulators have allowed the banks to be patient. If that continues past October, I think it was a 6-month window, that would be great, because I think the looming risk and for us and others out there is a refi cliff, and living through the last 08 recession, not having liquidity in a marketplace is it's not a fun place to be when you need capital. So we're keeping an eye on that and trying to get out with our lenders out ahead of any potential challenges or remargins should they need to occur, and just really trying to work and collaborate at a partnership level with our banks.
Great. So yeah, I agree with what everybody's saying. And I think it also goes to show that, we take a look at what's going in the markets, and then that will impact the credit and the underwriting and the risk profile that the lenders are taking. So all of these things we continue to watch. It's a fluid situation, but I think what everybody thought that possibly what was going to happen didn't happen. And the forbearance requests were not as high as everybody thought. And so again, like you said, the balance sheet is starting to come back. We've seen that as well. So that moves to our next topic. We're going to talk about what has changed with underwriting of both stabilized properties and construction loans. And we'll talk about it with the life companies, Fannie, Freddie, and HUD, and then balance sheet and or bridge loans. So all of the panels definitely chime in. I guess, Amy, why don't we start with you down there? So. Annie, I'm sorry.
Yeah, I think, underwriting is always a fluid situation based on how the market's moving, vacancy rates. I mean, everybody is pretty on board with that. I think the life companies will be interesting on the apartment side, because historically they're a low leverage lender, right? They're not going to be competing with the agencies all the time in the sense of getting up into that 75 plus leverage range. And so they're just generally more conservative. And I think that's even more true today than ever, because they like stability, right? They're lining up their real estate investments with their annuities and money that they're gonna have to pay out in the next 10, 15, 20 years. So we've definitely seen a huge dip in their volume. They've basically been kind of on pause the last few months. I think that's picking up a little bit more now that, we're heading into Q4 and there's a little more pressure to get volume out, which I think we'll touch on later. But I think their underwriting for the most part will be status quo, with kind of the more conservative nature of the way they underwrite to begin with. I think there will be a little more scrutiny on retail, obviously. So when you're looking at a mixed use project, they might stress that down, stress the vacancy. What if that tenant left? How reliant is the NOI on the retail portion, whether it's a grocer or some inline tenants? So I think that's where you'll start seeing a little bit more scrutiny, but I think otherwise underwriting will be pretty much in line with where it is, although we'll talk about this a little bit too, but I think at least in the short term, the nature of, urban core markets that used to be highly, highly sought after versus suburban, I think, the way lenders view the markets is going to shift a little bit, at least in the near term, which will be interesting to see how they're valuing that risk profile.
Well, so on the Fannie, Freddie, and HUD side of things, it's pretty much been status quo other than 3 credit enhancements that all of the agencies have taken. All of the agencies are now taking some sort of a debt service reserve to protect themselves from forbearance. So you're looking at anywhere between 6 to 18 months of debt service reserve. All of the agencies are now not looking at any kind of commercial income unless it's a credit tenant. So your mixed use property with some office space and the mom and pop coffee shop, we can't use that income right now. So that's been somewhat limiting for us in some of the deals that we're looking at. And then the last thing is that, and it's unique to Freddie's small balance program, they've just changed their cash out on any cash out deal. They've increased their debt cover by 10 basis points and reduced their loan to value by 5 basis points. So other than that, things are pretty much the same. There's some more scrutiny on collections, and we're having to verify collections several times throughout the process, and very much so right before we rate lock, just to make sure that that's still going strong. But other than that, it's the same as it always has been.
Yeah, I mean, I would say I'd agree with Annie that the underwriting's certainly been fluid over 2020. I mean, the first 3 months or 2.5 months of the year, I mean, we were on pace to have, one of our, we had best quarters to date in terms of, production and growth. I think, the markets were still very fluid and liquid, and, there was certainly a lot of activity out there. From a competition perspective, whether it's local banks, and we certainly, compete for structures with the agencies, that was pushing, I think, some underwriting to, not loosen entirely, but to be a little bit more flexible than it had been maybe historically. Then, March hit and into April, I think, everything really seized up. I mean, unless, and maybe to Nate's point, relating to relationships with your banker, unless we had a long-term relationship with a client, we went through our whole pipeline at the time and we're revisiting what were we working on. Does this make sense given the information or uncertainty that's around us? So we certainly tightened in at that time, and then since then, as we've all gotten our feet underneath ourselves a bit and have a little bit more clarity around, how this thing is shaking out, our underwriting standards have really returned pretty much back to normal. I mean, we whether it's a stabilized asset class or new construction, we continue to stress test the transaction, both on a vacancy and on a refinance test perspective. Those haven't changed. I think we are spending a lot more time and discussion in those on those items within our credit committees than we had been in the past. But we continue to be a relationship-driven lender, and for our clients that have been in this market, who know this market, who have long-term vision in this market, we will continue to find ways to make those transactions make sense for us and them. And the push and pull of the underwriting is, there's much more flexibility in that now than there was 90 days ago.
Nate, do you have anything to add, or?
And for the record, when I talk about relationships, I'm not pandering to Nick because he hasn't given us money yet, but I would say standards have certainly become more conservative, but I think the capacity to do, at least from a balance sheet lender perspective, the capacity to add more residential is pretty limited. So it's almost, with some banks, especially the larger, maybe money center banks, it's more of a binary decision to even look at deals. They're certainly underwriting more conservatively, but the allocation towards residential doesn't seem to be there. Everybody's added a lot of exposure, the last 10 years. They're not seeing a lot of runoff or refinance. And I can see that when we go to market on alternative industries like medical properties. We'll close a few deals this year, and the amount of interest and availability of capital on the debt side for those types of deals, I think it's helping balance out that stratification of industry within the banks. So not terribly concerned about the underwriting criteria. Fortunately, we have relationships. I think if you're a new sponsor trying to source new capital from outside relationship banks, it's more and more challenging today, but it's almost more binary. You're almost not going to get capital or get a look unless you have those relationships already.
So that's consistent too with what we're seeing. I would say from a refinance perspective, really the underwriting has not changed that much other than the COVID-19 reserves or debt service reserves, we call it COVID-19 reserves, that we talked about, and then really take a look at cash out. But really they're looking at collections. But from a pricing perspective, pricing is very strong. And from an underwriting perspective, it's still relatively stable compared to what it was. Now for new construction, that's where we're starting to see the differences. Obviously, it's more conservative, more equity is required. We're seeing more, 65% loan to cost and then heavy exit analysis, or really the loan to cost is no longer the competing factor. It's really the exit strategy or the debt yield returns that the banks are requiring. So we definitely have seen that tighten up. The one side that we haven't seen that tighten up is with the affordable housing, and that's because the GSEs will provide a forward takeout for affordable housing. And when the banks like that, because then you have a takeout, and I know our bank will do it, and we've seen this with other banks where we're not the construction lender, but they will underwrite to the Fannie or Freddie forward loan commitment, and that tends to be higher than what it would be if there was not a forward commitment. So that's one area where we're not seeing an impact from the markets in terms of underwriting. We are seeing impact a little bit on the demand side of it because of the delays in the LIHTC awards and all of the different maybe gap financing or LIHTC pricing, but from an underwriting standards that has not been impacted. So, all right, we will move on to how are lenders viewing the market. Basically, we talked a little bit about urban infill markets, suburban markets, maybe the Twin Cities market in general as compared to the rest of the country. So I will take it, we'll go right down the line here.
I think just reading some of the national headlines, Minneapolis has fared better than some of the larger maybe coastal markets as it relates to rent collection. I think that's obviously positive for us to see. Talking about Minneapolis and St. Paul and our Twin Cities community, from a broader perspective, we have properties that we financed, in outstate Minnesota, all the way through to the urban core. Most of our new construction products that we've done in the last 2 years have been, in the urban core, well-located, transit-oriented sort of developments. We have had conversation internally around, what is our appetite for and viewpoint around, really true urban core assets, given some of the uncertainty and, unrest that we had seen throughout the year. I am pro and believe wholeheartedly that, our core communities will rebound and that they will be consistent long term. I just think, the interim is a really uncertain time. However, we had assets that we had, under construction that delivered in March and April. And, those were obviously of concern to us going into this because of, not only just the difficulty of leasing units given the pandemic, then just with everything that happened with the death of George Floyd. I mean, we were concerned around the velocity of the lease up of some of those projects. And we were pleasantly surprised to see that they were hitting their lease up expectations that they had set at construction start. We're able to lease units through through COVID with pivoting on doing virtual tours, and I think that there have been the trends of working from home has caused some folks to say, well, hey, I've got 2 roommates and, my job, I'm still making the same amount of money I was before. Maybe I'll go, rent a micro 1-bedroom unit for myself because I need some peace and quiet because my roommates are all on Zoom calls all day long. So, that is, I think, some things that we didn't anticipate happening. I think we just assumed that everything would freeze up. And we were happy to see that the lease up in those units continued to perform well. So, I'm a believer in the core communities long term. I think the amenities, what has drawn folks to those locations, for 40, 50 years in terms of the lakes and nightlife and things like that. I don't think our population is going to shift so starkly that nobody's ever going to want to live next to Lake Calhoun or enjoy a burger. So I think that stuff will come back. It might take some time, but so as it relates to underwriting and thinking about new construction projects, I mean, we're certainly looking at lease up. We're looking at interest reserves. We're making sure that we're bolstering those as much as we can so that we can account for what could be a potentially longer lease up period than we anticipated. And then we're certainly stressing those rents to say, well, hey, if we do see concessions in the market, like they talked about on the prior panel, how well can that property weather that? So, but I'm a believer in the long term. I think those core locations will continue to do well long term. It's just uncertain in the short term.
We do have burgers in the suburbs. You're aware of that?
I live in the suburbs. There's some great burgers out there. Theaters. How about that? Not a lot of theater.
Yeah, not a lot of live music out in Minnetrista. So, I don't know. I don't know what's going to happen. And there's been some interesting things that we've seen in the news lately. Rent control in New York and coupled with the pandemic has pushed New York City vacancies to all-time highs. I mean, it hasn't been this high in decades. So is that a sign of what's to come for other urban dense areas? I mean, Minneapolis has obviously made some pretty drastic changes in restrictions and for owners. St. Paul just rolled out that new ordinance that goes into effect March of next year, which is going to make it very difficult for people to create value, do value add in that market. So, I don't know what's to come. Maybe people start moving out into the burbs. Maybe people are sick of living in micro units when you were, quarantined for 12 weeks and 500 square feet. And maybe that pushes people to think differently. I mean, perhaps the, 2.5% mortgage rates are going to, incentivize people to go out and buy houses. I don't know what's to come in the market. I think only time will tell. But we're still bullish on doing business in the urban core as well as the suburban markets. Greystone as a company has never been very big at doing outstate or smaller market stuff, but we're always going to be active doing urban and suburban around major NFL cities.
We have younger kids, but what I've seen through my sister and brother-in-law, when they have 20-something kids, you can only live with mom and dad for so long, and roommates for that matter. So I think things will come back to center. Not surprisingly, we've seen lower renewal rates at some of our properties because they're predominantly urban infill. But I've been happy to see the leasing velocity. Even with establishing virtual tours, Jamie's in the middle of running that right now. That we've seen a lot of success there and a lot more traffic than I anticipated. That being said, we're still in some of these submarkets concessionary lease up environments, and that's concerning because there is still additional supply coming to Kyle's point. But we've been focusing last year plus on first ring suburban locations, trying to look towards where is their future demand, and hopefully we find pent up demand on top of that. And I think you've seen relative performance is held pretty strong in those particular submarkets. But the urban environment will come back. I think the transit isn't being used like it has. But you look at Apple Maps, and I saw a graph the other day. You look at driving and walking activity has basically rebounded from pre-COVID levels. Transit's still way down, but I think there's still a desire to live in walkable, highly amenitized neighborhoods. Concerns there are really, for me, more around real estate taxes, and we talk about underwriting. Forecasting increases in real estate taxes is challenging, especially when you look at some of the local state budget issues. New York being one of them, cutting hundreds of EMT employees potentially here because they can't balance their budget. We're in markets like Minneapolis, Portland. I don't anticipate there to be a slow growth in the real estate tax category. So keeping a focus and an eye on that. And the other piece for us is really what's happening with the retiree category. We were in some of our assets, targeting a decent percentage of demand from retirees, and retirees without safety and security. I'm guessing, and if we can improve conditions, that'll come back. But right now, I think that's a concern and a potential impact, which is leading to, I think higher than average concessions in some of our marketplaces. We have an asset in Portland, and I think they're on their second, third month of straight riots and protests, and it's concerning, and we're seeing higher notices to vacate. We need to see something stabilize there because the trend is not great.
I echo a lot of what was just said. I mean, as it relates to Minneapolis specifically, we generally have been a more stable market historically, as there's been bumps in the economy. If you look at the kind of 08 recession, it's generally the coast, the east and the west that have those lower cap rates going in that are hit a little bit harder. I mean, they're a lot bigger cities too. So I think that's always been a positive thing for Minneapolis, and a lot of the reasons that investors, especially more institutional groups, have kind of flocked here over the, I would say the last 5 to 10 years, more so than prior to that. I think similar to what Nick said too, I mean, the core will come back. I think in the short term, I had a lot more calls with lenders that do business in Minneapolis, but maybe they're based in New York or wherever it may be, that are kind of like, oh God, what's going on in Minneapolis? George Floyd, like, ooh, and they're not boots on the ground. They don't know our city like we do, and appreciate what the core is in terms of downtown life, urban, uptown. I live right near uptown, and I think all of that is going to be there in the long term. I think the short term is a little bit of a knee-jerk reaction, as it should be. People are losing jobs. Maybe they are moving back in with parents for a little bit, or in the opposite of that, getting their own place because they want to get the hell out from their roommates or whatever it may be. And then same with well-located real estate, like Nate was saying. I mean, look at Hopkins, Robbinsdale, kind of our inner ring suburbs, that they have those amenities that are walkable. People want to live there, whether they're buying a house or renting an apartment, that have been really strong the last few years. And I think we're going to continue to see that velocity too. But by the same token, we do, have to keep a check on concessions and overbuilding, which I guess I long-term feel like that's not necessarily a problem, because if you look at stuff that was built 20 years ago, that's going to be affordable housing, and it's kind of a trickle-down effect too. So we need that supply to keep continuing, regardless of what's happening in the short term in the market outlook. But I think a lot of it has just been more educational for people that aren't in Minneapolis, of what's going on here, how our markets are performing, whether that's urban or suburban, which is fun to do. I mean, it's easy to say good things about our city, and obviously we've gone through a bit of a reckoning here, and that will continue to play out. But I think, the long-term outlook is still really positive for our cities.
Great. So the next question I have has to do on capital supply and the remainder of the year, and volume. As everybody maybe remembers from last year, especially with the GSEs providing liquidity, if they hit their volume caps, they tend to spreads widen immensely, and they say they're in the market, but really they're not. So I'd like your thoughts on volume expectations for both the GSEs and life companies. So Amy, why don't we, or Annie, I keep saying Amy, I apologize. Annie, why don't we start with you?
Yeah, so I would say, I mean, as it relates to the life companies specifically, they're behind, similar to what happened with the agencies last year, where they just kind of froze on apartments, or were just out of the market effectively while they were kind of triaging everything that was going on, more pandemic related. But I think in Q4 we'll see a little bit of an uptick. I mean, they still have X number of dollars they need to get out for the same reason I said earlier, that they just need to line up their portfolio and their annuities and get dollars out regardless. So I think they'll be under where their targets were, just because this pause on their end has been 4 or 5 months here. But we are seeing for that lower leverage stuff, well located, they're trying to compete more with the agencies. So rates are between 2.5% and 3% in most cases for that lower leverage stuff in life company underwriting world. And so I think that they'll be behind by the time the year ends, but overall, I think we'll see a little bit more of a push here, especially with the election. We don't know what's going to happen with the markets and Treasury, and there could be a lot of unknown spikes that happen or policy changes that will affect what's happening.
Kyle, so what's your perspective with the GSEs and HUD and Treasuries?
I have no idea what's going to happen with the Treasury. Yeah, that's impossible. But last year at this time, the agencies had reached their caps, and spreads blew out for about 60 days until they got their scorecards for 2020. What we're seeing this year, spreads have been very stable for probably the last 4 months now. I know that the agencies have both filled their buckets in the 5 to 50 category. They are completely overwhelmed right now with affordable business. But those categories generally are going to remain stable throughout the rest of the year. I think spreads are probably going to stay where they are until the scorecards come out. When the scorecards come out that show how much Fannie and Freddie and HUD need to lend for the following year, they generally tighten spreads a bit to start driving in new business that will be delivered to them in January of the following year. So I would expect sometime in the late September, early October to probably see a 20 to 30 basis point reduction just to start pushing business for 2021. But the agencies are out there, they're lending. Like I said before, there's a few credit enhancements, but I mean, we really haven't missed a step like some of the other lenders out there.
Well, it's not good for me if you're going to cut your rates 30 basis points even more than they already are. Yeah, I mean, I think for banks, I think people have really short-term memories. I mean, the 10-year Treasury was, at 1.5% not that long ago, and it at 60-ish basis points now. I think it cracked 50 basis points at one point. So I'm a balance sheet lender. Every loan I originate, we hold on our balance sheet. We bring in local deposits and we turn around and lend them out. So it gets difficult for me to lend, low 3% 10-year money when I'm trying to fund that with all local deposits. So, as that relates to, volume on a go forward basis for the rest of the year, I mean, for all the reasons that the prior panelists talked about, I mean, apartments continue to be a preferred asset class for banks to finance. Because of that, if you go to your local bank with an apartment deal, they'll try to find a way to get it done. Now, our rates are likely to be higher than what the agency rates are, but I think, some of those COVID-related reserves, that has pushed some borrowers to banks. And we've seen transactions that have come our way because folks have not been interested in or willing to, put those reserves in place. And I, as a portfolio lender, may be more, willing to forego that just due to, guarantees or, other sorts of, fundamentals of the transaction. So I would anticipate the volume, which really fell off a cliff in March and April, has started to come back now. I'd anticipate that continues to, incrementally increase through the balance of the year, for banks. So it does get hard to compete with really aggressive agency lenders.
But we lose business to you due to the agencies they have very restrictive prepayment penalties.
Right.
And that's where we lose out. So more often than not, when people aren't interested in a prepayment penalty or looking to do something with their property 2 to 3 years out, I tell them to call you.
Right. Yeah. I mean, there's certainly the right fit for the right project, and every project and borrower has different investment thesis and time horizon for that transaction. And somebody refinancing a legacy property that they're going to own for the next 20 years. I mean, that's where it does get difficult. But certainly, variations in how we can structure transactions, the flexibility is what we provide.
So yeah, that's a good point. There's lots of financing options out there. Financing and underwriting is still relatively stable. And again, talk to your relationship managers, and I think that you'll be able to continue to find good financing options. So I was going to end on a quick note. It looks like we're almost out of time, but maybe each one of you can just say, what is your overall outlook for the multifamily market, both short-term and long-term? We can keep it short here because it looks like we're running out of time, but yeah, maybe just do a brief summary of what your outlook is.
Yeah, I mean, I'll steal everyone's thunder. I think short-term, there's there's some uncertainty. We're going to have to work through, concessions and some vacancy, but the long-term fundamentals, I believe, are there. I think low-cost debt will continue to fuel transactions, unless we see meaningful increases in debt prices, which I don't anticipate. I think the market will remain pretty liquid and active.
Well, unlike the rest of my colleagues up here, multifamily is all I do. So here's to hoping that it stays strong, or I might not be here next year. So, but yeah, I think it's going to remain strong. Everybody needs a place to live. I've always said that you don't always need an office. You don't always need to have a retail space, but you always need a place to sleep. So hopefully it stays strong.
I hope you're right, Kyle, and I hope you're wrong on the new supply threats, so we can continue to justify some development. But I think generally, you look at the last 15 years, apartments have been the best risk-adjusted return out there. Whether that continues or not, it remains to be seen. KKR came out with a report not so long ago, just kind of hitting on the broader economic, macroeconomic themes, just around the Fed balance sheet size, which is record levels, spending as a percentage of GDP. I mean, we're back to World War II levels, which is just unbelievable. But there are record amounts of capital out there. I think a lot of that money, and especially the investor side, is being pushed in search of yield, being pushed into higher risk investments. And I think the view, given the money supply and out there, is that alternative assets, including real estate, could be still strong and have some legs. I think they predicted the CAGR for the next 5 years could be the third highest behind private equity in emerging markets for real estate. I think a lot of that's driven by warehouse logistics and apartments. But I think it will be potentially the have and have nots. Some of these larger cities, Chicago, San Fran, New York, I think it could be years, not months, before we start to see a baseline and some recovery.
But I think, what could, everyone, the fundamentals are there for apartments. So I'm positive on that. But I think what could be interesting, like Nate was saying, with the amount of capital and liquidity out there, what amount of that right now are people sitting on, waiting for kind of opportunistic investments to come around, whether that's 6 months from now, 12 months from now, 14 months from now, that kind of remains to be seen. And so there's the flip side of that. There's the ABCs always be closing, as everyone in this room I'm sure knows, that you want to get dollars out now, and you have to continue to transact even in up or down markets. But I think the opportunities of any perceived fallout, and that's probably more on assets that are not apartments, and where you can find a little bit more yield down the road relative to the bond market's obviously low right now, and in those asset investment classes. So I think that part will be interesting. I mean, it's finger in the air. We don't know where that will fall and when we'll kind of have a end in sight for the pandemic here. But I think overall apartments are going to continue to be the darling of real estate.
Great. So first of all, I want to thank everybody on the panel. Your insight and knowledge to the ever-changing situation is much appreciated. I do think there's been positives, and the apartment markets tend to have been stable and not as possibly as drastically hit as everybody maybe thought in March and April. And we continue to watch the trends, but so far the trends have been positive. And again, that's why I think you have not seen a whole lot of change on the underwriting parameters. And, stay tuned. That's really all we can say. We continue to watch it closely. So thank you.
All right, so we're going to do about a 10-minute break. If you're here in person, restrooms are out back off to my left over there. And if you're watching from home, go ahead and pop off this webinar and go back to the lobby, and we're going to be starting here at about 10:15 or so. So take a little 10-minute break. Thanks. Yeah. Yeah, mix it up. I don't know. Did somebody leave? Is that yours? No. Somebody. All right. Yeah, we'll start at about 3-4 minutes. Yeah. Hey, Chris, there was so on the chat room, for the first panel, there was like 3 questions, and maybe you guys want to talk about it today with regards to like evictions and what that's going to mean and how the court system, once the eviction moratorium gets lifted or whatever, what's that going to mean to apartment owners and stuff in this market? What's it going to mean? Are they going to, and then are all the courts going to be in favor of the resident versus the landlord? And,
it's broadly, it's going to have a very nominal impact on the market. We've got 3% of our total renter base of 7,000 units that are on deferred payment plans. So our collection rate in our market rate has been 99.3, affordable's been 94. Of the 3% that are on payment plans, I think 60-70% will catch up. And we're going to talk a bit about some of these rent programs out there that.
So maybe you should talk. I think that should.
I'll hit with that. With the renter relief program.
There was 3 specific questions on that. We had like 6 questions and 3 were on.
Because I think people are somewhat to that point concerned that that's going to have a big impact, and that we're going to have all these evictions. We'll have some. I think 1%. But it's going to be a small amount.
And then there are probably, and then another question was about downtown Minneapolis. Is what's downtown Minneapolis look like right now on vacancy? Vacancy, is it different than out in the burbs?
Yes.
And is it going to change? Is it going to come back? And what's going to,
I think we're going to hit all those. We on our call. So
okay. Yeah. So that was a big question as well too. That somebody like that once. So somebody like that. There was a couple people like, ask that question about downtown.
Downtown vacancy is going to be double digits here.
Yeah.
Fourth quarter.
Yeah.
I think for 12 months.
Yeah.
And then it'll come back.
Yeah. So you got
hopefully not 12, hopefully 9.
Yeah. Right. Oh yeah, then somebody thought, and then the other question about safety of tenants. That was another question twice.
So safety of our
tenants,
residents, and our team members too.
Yes, team members. Yeah.
Because I'm kind of opening up with that. I mean, it's nice to be here in person, but for operations, we never sit behind the computer. We were always right out there.
Right. So that's good. Yeah. And being that this is
so
operation
from March 13th on, I mean, it was just that was our first focus: is how do we keep our customers and our team members safe?
Right. Exactly.
Only thing we got on the camera right now is your balls.
I tried to grow back.
I was gonna go stand next to you and see whose is worse. I think yours is more round. Mine's kind of splotchy. I just shaved it too. We all can't have nice hair like Cal or Chris.
All right, so here we go. So if you are here in person, I know there's a bunch of people out networking and stuff in the hallway. And if you're at home, please do me a favor. If you're at home, just put your name in the chat room again with your license number would be fantastic if you can do that to help us out. And we have 4 more real estate CE questions for people that are watching from home. So please make sure you answer those questions. There'll be about 2, or there's going to be 2 per hour. So, all right, so I'm going to turn it over to our next panel. This is our operations panel. There was a couple questions and stuff in the chat box earlier that I know this panel is planning on addressing as well too. So moderating this panel is Chris Sherman, Senior Vice President of Sherman Associates. Chris, it's all yours. Please take it away.
Thank you, Jeff. I'm Chris Sherman, Sherman Associates. We're going to let each panelist introduce themselves before I pass it off down the line. Sherman Associates, we own and manage about 7,000 apartments based here in the Twin Cities. So a bulk of our portfolio is in the Twin Cities. Over the last 5 months, there's been a substantial shift in how we operate. And from day one, for us, for operators out there, of course, I mean, it wasn't going immediately to work from home. For our team members out there, the immediate focus for our team members and our customers was safety, because we had to continue to maintain the properties, operate the properties. So from the very get-go, March 13th, jumping on those 8 a.m. calls for our team is very important every single day for the first month as we shifted how we operated, went virtual as much as we could. But the properties, the communities stay open, of course. We're providing 24/7 housing, 365 days a year. So today we're going to speak a bit about how it's changed over the last 5 months and really what's going to occur in the coming months and into the future. And some of the things that we've done over the last 5 months, I think will really stand the test of time. Some of the technology upgrades. We are going to address a couple of the questions that have come up in the chat room. So we look forward to going through all of this today. I'll pass it down the line.
Good morning, everybody. Todd Eatman with Core Living. We are based here in Minneapolis, and our portfolio is in Minnesota, Wisconsin, Iowa, North Dakota, South Dakota, and Montana. And we most of our properties are all in the suburbs, and we have a little bit, almost 4,000 units. Our pipeline is going to bring us up to about 10,000 units by 2025, and we're mostly, I would say, Class 8 property, not luxury, is what we mostly have. So I'll turn it over to Jamie.
Good morning. I'm Jamie Perrin with Saturday Properties. We're a local developer and management company. We manage about 1,800 units in Minnesota. 1,000 of those units are in Minneapolis. The balance are in kind of that first ring suburb group. We have about 100 employees, so we're new, just started 5 years ago, so we've been rapidly growing and adjusting to the pandemic and the Minneapolis market.
Good morning, everybody. My name is Pete Bussey, CFO of Real Estate Equities. We're based in St. Paul. Currently have about 4,500 units owned and managed in Indiana, Minnesota, and Wisconsin, mostly in the Class B range and strictly affordable housing since 2016.
Thank you. So as you can see, we have a big pool of data here to grab from and provide today. So we're going to start off with collections and occupancy, both looking at collections and occupancy from a market rate perspective and affordable perspective. We're also going to speak a bit to leasing, some of the lease ups that are occurring in each of our portfolios and how those have been impacted. So for Sherman, we have both market rate and affordable. We're about 75% affordable, 25% market rate. Our market rate collection rate has held very steady through this period into August. We've been collecting at about 99% plus month in, month out. We actually saw an uptick from June to July, which was purely probably just coincidence. I think we will see that continue to hold steady. It's been the affordable in our Class C that's kind of trailed off here as we've headed into August. When this started in March, April, May, we were at 94, 95%. As this has really expanded into now a period where we're in between stimulus bills, in between the unemployment boosts, that has started to cause concern for a lot of our
lower income households that are being certainly more stressed by the economic conditions, by unemployment. And we've seen our collection rate go from 94, 95 down to about 91, 92 in our affordable. So it is critical here in the next couple of weeks that hopefully the next stimulus bill be passed, as that's starting to have an impact on our collection rate. Occupancy, we've held very steady in the suburbs. We've actually seen an uptick in our occupancy. Downtown, we certainly have started to see a little uptick in vacancy over the last couple of months, and I think that will continue through the fourth quarter into the first quarter. But that's kind of where we stand for those two metrics. Todd?
I would say same for the Minneapolis market. Our collections for all of our stabilized properties are somewhere between 97 and 100% collected. We do have one college property up in St. Cloud, and just with everything that's going on with kind of the college reducing resident size and student size, the vacancy's been higher and the rent collections has been lower. But fortunately, we didn't give any concessions this last. Usually we do like a stay concession for our residents to stay through the summer, and we didn't give that this last summer, and our income's actually up compared to where we were supposed to be, so we're happy about that. Our Iowa college property is actually doing really well. We're 98% pre-leased for this coming year, and collections is 99%. So those are the two college properties we have. Other than that, we have 5 lease ups going on right now. We have one in, let me think of all of them. We have them in Chanhassen, Burnsville, Minneapolis, Duluth, and what's our last one we have here? I wrote them all down this morning, getting a little flustered here. Oh, Buffalo was the last one, I apologize. But all those are doing well. We are at or exceeding lease up, so we're super happy about that. We don't really have anything in Minneapolis, so we're not getting affected by that right now. So turn it over to Jamie.
The same for us. So the bulk of our portfolio is market rate. We do have some workforce housing and a small amount of affordable, but our rent collections have remained high, 97 to 98%. Although I will say the workforce housing, we've seen it dip a little bit to about 95. Vacancy, we're starting to see an increase in vacancy in Minneapolis. We manage about 1,000 units between Uptown, South Minneapolis, downtown. So we're starting to see, while we had high retention at the beginning of this, we're starting to see that taper off a little bit, seeing some people move out of Minneapolis. We have one current lease up in this market. It's in Richfield, so it's remained strong, really great leasing, great rents. So that's where we're at.
Collections across our portfolio have been strong as well. We've been seeing about 98% across our market rate portfolio and about 94% in our affordable portfolio, which is actually surprisingly about 1% higher than our 12-month trend. So I think people are holding their housing close to their hearts and making sure that they're taken care of from a housing perspective. So that's been good to see. We've been, monitoring payment plans, and in the beginning of the pandemic, we had about 3% of our portfolio applying and working with them on payment plans, and that's actually dropped to about 1.5% to 2% here over the past couple months. So that's actually declining since April, which is good to see. We opened up a senior affordable building in West St. Paul in the middle of May, and we've seen a very strong absorption rate for that. We're already about 70% leased and occupied for that building. However, on the negative side, we do have a couple buildings in Lower Town, St. Paul, and have seen significant drops in those markets and down into the mid 80s. And seems like people are fleeing for their parents or for safer refuge outside of the downtown area.
So as you heard there, I mean, the collection rate in Minnesota has been very high when you compare it to the national average. I mean, we have performed well, and I think that's been in part because of our unemployment rate being so low. The national average right now for the unemployment rate is about 10%. Minnesota's a little under 8%. When we talk about deferred payment plans, one of the other subjects that comes up is evictions. I mean, we are working closely right now due to it being the right thing to do, number one, but also because there's a moratorium on evictions. We're working very closely with our residents on deferred payment plans, and we have about 3% of our households, about 230, that are on deferred payment plans. As we look out the next 30 days, I mean, the question for us is what are the next steps we can take? And there are some really good tools coming into our markets for helping out these renters that are struggling, they're probably unemployed, they're truly being impacted by economic hardship right now due to COVID. So some of those programs, the renter relief program, that I think, Pete, you've experienced some good results with the renter relief programs.
Yeah, so we've had really good luck over the past couple weeks, particularly with working with local nonprofits that got grants as it relates to the CARES Act. So I'm not sure the numbers, but many local nonprofits got anywhere from like $100,000 to up into the high millions of dollars, and we've been coordinating on-site pop-up shops in our club rooms, and just invite the residents down to come and work with those local nonprofits. And they are happy to issue funds directly to the building for both rent and for utilities, if you have RUBS or that included in your rent. So we've seen probably over the last 3 weeks, I would estimate that we probably collected about $300,000 to $400,000 worth of back rents from the local nonprofits. So it's really great for them because they're looking to utilize those funds quickly, as it relates to the CARES Act. And it's obviously great for our buildings and, best of all, great for our tenants, and allows them to stay in the units and make sure they feel safe and comfortable in their home.
And I think this will become even more critical here in August and September as we're in between stimulus bills. And previously, a lot of these individuals were receiving an unemployment boost. They'd gotten the stimulus check, the $1,200 check a couple months ago. Those things currently are in limbo. And I think certainly we hope that the stimulus bill gets approved here in the next couple of weeks. But there's other kind of sources out there. And some of the cities are also providing some assistance here, which is very helpful. Todd, can you speak to some of your experiences?
Even this last week, I was talking with the city of Roseville. We took on 277 units this last week of management. And through that process, we were talking with the city, and they, not only them, but other cities in town are starting to get money through the CARES Act. So they're receiving $10 million through the CARES Act, and they'll be rolling it out in the next week, where residents can apply for up to $10,000 per household. So I don't know that it's widely publicized, but if you do have apartments where residents are needing extra assistance, or they are on the list to potentially be evicted when that comes around, there are resources for them. Even they said some of these funds will even pay for internet, a desk, if they need to be working at home, all kinds of different things that are COVID related. These dollars will be for that. So I know Roseville in the next week, they're going to be rolling it out, and then other cities are doing the same.
So I think, real broadly, Minnesota is doing very well compared to the national average. And I think it's in large part because we have a strong employment base. Our unemployment rate's low. We are seeing strong collections, strong occupancy. The suburban markets certainly are performing better. Affordable is starting to feel a little bit of the drag, but we really do have a strong market here when we look at the national average. So next up for kind of subject, as we progressed into this, the thing that really needed to occur very quickly is we had to stay open. We could not close our properties, our businesses during the March, April, May months. So we quickly were forced as an industry to advance our technology and go virtual. So that was a big component of what we were focused on from day one, is really how do we go virtual? How do we minimize the amount of interaction between our customers and our team members while still being on site? So I'm going to pass it down to Pete again to just talk a bit about the technology that you guys have implemented the last 5 months.
Yeah, so we've always, prided ourselves on being, not on the cutting edge of technology, but want to be pushing, the edge of comfortability for us. So this is a situation where it's better to be lucky than good, and that we were prepared, but we didn't know what we were prepared for. And then the pandemic came along, and we looked really good in the process. So we had, virtual leasing ready, Matterport walkthroughs for all of our apartments ready to go. And then also our lease process, all the way from application to payment, security deposits, all that is online, and a person basically never has to see their apartment or see the leasing agent to be able to lease an apartment for us. And that was particularly important for us on the affordable side. We had rolled out probably 6 weeks prior to that our entire affordable application payment process, recertification process. All of that is available to do online through Yardi. So it was a situation where it was just kind of the right time and allowed us to, do virtual leases, virtual walkthroughs. We were doing FaceTime walkthroughs and in situations where that was needed, and, had pretty good luck with just being ready to, appease tenants that weren't really looking to have a face-to-face interaction. And I think it resulted in a positive, result for both us and our tenants.
And we'll just take it back down the line, Jamie.
So the theme for us, I think, we're always exploring new technology, but I think facing this in March and how quickly it came up, we had to shift very quickly to. So there was a pause for us as we adjusted to. We've always offered FaceTime tours, things like that, but we really had to shift, and the virtual tours became really important for us. So 3D tours of apartments. We're working with a vendor that can put those together very quickly. So that's been really helpful. We put together a process for contactless tours. So we were able to get back on site in May and start touring people without contact, which really helped with our leasing efforts. And we also implemented a new process for a contactless move-in, which has been great. We've gotten really good feedback on that. So we've been able to really, like Pete said, people don't even have to see us, and we can still provide the service and the responsiveness that they're looking for. And what we've found with our demographic is technology is really important application. So our resident app is really important to our renter. And so as long as we can be really responsive to our residents, I think our resident satisfaction has remained really high, which, I think that was a concern that we wouldn't be able to be in front of our residents. But I think as long as they're hearing from us and we have lots of video conference calls with residents and things like that, but it's really ended up working out well for us.
You want me to jump into the next thing, or I don't have a ton more to add other than that. I think that just making it personal, even when we did the contactless move-ins, we would have the manager say, hey, call us when you're walking up, or the leasing people, and, we'll wave at you, please go in, and we'll FaceTime you as you're walking through the building. And depending on their comfortability. So I think that's what's been huge, is everybody's been in a different place and just understood, what are you comfortable with? We are here every day. We probably are a little bit more comfortable than you are. Even some of the managers or staff that weren't comfortable at first, I think just being there every day made them more comfortable. So I think that, we communicated a ton. We did, I think one thing that the managers appreciated is, and they even slowed us down after a while, is we were doing weekly calls with all the managers. So we would do weekly Zoom calls with myself. The other leadership team would be in there just asking what kind of support they need. So I think that was huge too. And then also lots of communication with the residents. So.
And what we've seen is, just the conversion rate of prospect to lease going through the roof through this process. The residents now, certainly during May, they were kind of forced to do the virtual tour. And we were forced to quickly provide the virtual tour, and a lot of us had that set up, but conversion rates have gone up a lot. And the other component that's gone up a lot is retention. So between the ease of leasing and retention and other things that have helped reduce expense levels, and the one offsetting factor to lack of revenue growth, the big one, has been the decrease of direct expenses. And I think across the industry, there's been certainly a substantial decrease in direct expenses as a result of higher retention rates and just a streamlined leasing experience. And the leasing experience, I think, certainly is a long-term enhancement that will allow multifamily, as we look out to underwriting future deals. I think this will be a long-term expense modification on how we're approaching leasing, just by building the infrastructure and really giving the resident a better opportunity to tour 15 properties from whether it's their couch or a park or somewhere else. But they're really now doing a lot more over the internet, over the websites, and that's leading to a higher conversion rate, because by the time they come through the door of our property, they've already gone through our unit, done their measurements, done the 3D virtual tour. They know exactly if their couch is going to fit. They don't need to do as much in the property, so they can be in and out within 15 minutes and kind of say, yeah, this is where I want to live. So we've really valued how far the industry has gone the last 5 months, probably further than we've gone the last 4 years combined.
And a lot of that's been peer-to-peer interaction and collaboration. So our next one that we want to discuss is this has been a really important one in the last 5 months is the amenity spaces. Initially, the amenity spaces were closed. We closed our fitness centers, our pools, our community rooms, and this was for the first several months. And really, as a requirement, they were closed, and also just as a precaution. But over the last couple of months, we've seen a lot of those amenity spaces reopen with new rules, new signage. We've gone out and bought hundreds of gallons of hand sanitizer from a local distillery. That was the best source we could find. But there's been a lot of things we've had to put in place to make sure these amenity spaces were safe and met the guidelines of the state. We are now largely reopened with occupant restrictions, usually 5 people in the fitness rooms. We really are trying to have our residents follow these rules closely. Obviously now face masks are required. The fitness room we are currently not requiring but highly recommending face masks, but all the other amenity spaces we do require face masks throughout the common areas. So let's just speak a bit to the amenity spaces. Tom, I'll pass it back down to you and we'll just go down the line.
Sure. I would say we haven't tried to be trendsetters in this area. At first, we were all trying to figure out how we were going to handle this, but we decided on as soon as the city or the county or the state made a decision on that space, whether it's how are you guys going to open up your fitness centers or other amenities, we just followed pace behind that. So if the city said, hey, we're going to open up, Lifetime Fitness now or the other LA Fitness and those kind of, we would just follow suit with that within a week was how we've kind of went after it. One thing I did forget to talk about is kind of the fun things we've done for the residences. We first did like a virtual bingo. We did that. We put surveys out to all of our properties and said, what would you like? So one group said, we want to do virtual bingo. We did another virtual happy hour. We were a little nervous about some of this stuff. It's like, what happens if we get a whole apartment building doing virtual happy hour? But it was okay. They also did a drive-up happy hour where one of the local vendors just put a table outside of our before you pull into the garage, and you could grab a beer or some chips or whatever you wanted, and they wiped everything down and sanitized it. So that was one thing. People thought that was fun. And then we also did a movie night, social distancing on one of our pool decks. So we had one property has a larger area so people could span out, and we had a big projector. So we've tried to keep it as fun as an interactive. And we only got in trouble once because another group, they thought it was our manager, but it was just another private party that was kind of getting a little loud one night. So, so it's been as fun as we could try to make it, but the residents that are comfortable have enjoyed it. So that was the one piece I wanted to say. Other than that, our community rooms are open, social distancing, fitness centers. They even opened up, both of our college buildings or all three, I should say, have tanning beds, which still is interesting to me, but they have opened that because we got a big demand for that. So it's an interesting time. Turn it over to you, Jamie.
So we had the anticipated resident backlash of shutting down all of your amenity spaces on the same day. And so we put together a task force to work through how we could safely open up those spaces. And the first thing that we went after was the fitness center, because for people who work out that couldn't go to their local gym, it was going to be really important for them, for us to be able to open our fitness spaces for them. So we worked through that. I think the challenge that we faced, the biggest challenge was in the beginning was working through staffing, right? So it was increased. We had to sanitize the spaces. There was an increased cleaning schedule when we were trying to keep our employees in a safe space, and we had reduced some of our staff hours. So that was probably the biggest challenge, was getting through that. But I think we were probably one of the first companies or management companies to open our fitness centers. Obviously worked through that with owners, but masks are required. We've always required them in all of the spaces, but then we've slowly reopened in phases, obviously reduced capacity. And then, in trying not to punish all of the residents, we really try and pay attention to people that aren't paying attention to our guidelines. And so we reach out to them directly to try and police that, not something we want to do, but something that we need to be able to keep those spaces open for people. We've also moved into virtual events as well for residents. I think that's been really important. So especially with people stuck in their studio apartments for the last 4 months, they've really wanted to find ways to connect. And so we've worked through that too. So quite a few virtual events, Sip and Paints. There are some vendors in Comcast, I think Xfinity, they offer to coordinate that for you. So they're a great resource. We just had a mixologist class. So that was kind of fun, a virtual class where we provided things for our residents for that. And we've also moved to food trucks. That's been like kind of a fun social distancing resident event. As we haven't been spending as much money monthly on our resident events, we're able to throw a couple of bigger events for people too. So just finding ways for people to connect when they can't gather in our common areas like they used to be able to has been really important for us.
Yeah, we took a similar approach. We locked it down in, mid-March or late March, and then kind of taken a staged approach, with I think most amenities being back open by late June, early July, probably in that time frame. And we've done similar things to what Jamie mentioned. We've done some food trucks. We did I wasn't there, so I don't know exactly what this means, but a Doggy State Fair open house last week in St. Paul, and I guess we had a pretty good turnout. So people seem to enjoy that. But similar to Saturday, we also wanted to make sure that our tenants felt comfortable, so we wanted them to be seeing our cleaning crews, going around the buildings. So we immediately in March introduced a hazard pay for all of our on-site employees, and made sure that our tenants were still feeling taken care of and able to use the amenities in a safe way.
Thank you. So over the last 5 months, we've collected a lot of data that's allowing us to kind of project out a little better what's going to occur here as we progress through the balance of this year and into next year. And the next subject we're really going to focus in on is what we do envision the next 3 to 6 months. And we'll start with collections and occupancy as we progress through the balance this year. As we look into kind of the second half of this year and into the first quarter of next year, we truly do think that that's going to be the most challenging period as we move through, and hopefully we get to a vaccine and get to next spring. But there will be a lot of challenges, and I think one of those challenges certainly is the fact that schools largely are going to be doing at-home schooling, and that does pose additional stress and costs on families. So I think that certainly is a larger concern as we look to the next stimulus bill and how that's going to impact the family dynamics. But for us, I think certainly with our affordable, we do think we'll continue to see some trend downward in our collection rate, probably down to about 90%. Right now we're at about 91, 92. With market rates, I think we'll see collections hold very steady. But the vacancy in market rate in certain pockets is going to uptick. I think we'll see the collection rate stay in the 98, 99% range. But mentioned on previous panels, I do think we'll see some negative rent growth. I think we'll see rent in cores go down in 12 months by a noticeable amount in the short term. I think we'll see vacancy in the short term get double digits in the downtown core. I think 18 months from now, we're upticking back to more of a stabilized 95%. But between now and then, I do think we'll have some vacancy challenges in the core. In the suburbs, I think occupancy is going to hold steady. I did not mention our lease up earlier. We're leasing up a building in Coon Rapids right now, 180 units. Started the lease up in March, right at the beginning of COVID. We're 80% leased. We've taken a lease every single day since we opened at slightly above underwritten rents and no concessions. So the suburbs certainly are seeing an uptick in demand as we kind of go through some of the short-term challenges in the downtown core with the event spaces and other spaces closed. So I'll once again pass it down the line for each of your comments.
I think we anticipate the same. So again, most of our portfolio is market rate. So rent collection has remained steady. So I don't think that that's a major concern, but obviously there's a challenge with the increase in vacancy, particularly downtown. We're seeing some challenges in kind of the uptown Lynn Lake area. I think we're anticipating some rent decreases. We're seeing some increased concessions in those markets, which were challenging to begin with. There's quite a bit of new product. So I think we're walking into 2021. We anticipate, some lowered rents, a little bit higher vacancy. Usually we looking at, 5 to 6% across the board. I think we'll anticipate a little bit higher than that, a couple points higher in most of our markets. I can't believe I forgot to mention Nolan Mains, and everyone at Saturday is going to be so mad at me when I said we had one lease up. We're 85%. So we opened up a project in Edina, and so same sentiment. I think the first tier suburbs occupancy will remain strong, rents are strong. So we opened up 100 units at 50th and France. It's been a fantastic lease up for us. We're 85% leased. So started taking occupancy there at the end of last year. So it's, I think, and we're working on a 316 unit project in Richfield, working through that lease up, and it's close to 80%. So it's, and that opened again, end of third quarter, beginning of fourth quarter last year. So it's, strong leasing, strong rents in those areas. But I think, the challenge for us is going to be in our portfolio is really trying to hold steady in the downtown and uptown markets.
This is a very relevant topic. We just had our budget kickoff meeting to extend the everlasting battle of operations and finance, one needing cash flow and the other one needing, to keep our apartments filled. So I think the reality is we'll probably land on a, 5% vacancy on average across our portfolio for 2021. And we'll be lucky to keep rents flat is probably where we may not budget for that, but I think that's probably the reality, even though I know that, property taxes and insurance, there are two, second and third biggest expense line items will not be flat in any way, shape, or form. So it's, keeping those debt cover tests, satisfied, and keeping investors satisfied, and maintaining what we think we can actually expect to see in 2021 is going to be a pretty big challenge for us.
I think I always get in trouble for being too positive, but I feel pretty good with where we're at. We're fortunate to be all in the suburbs, and our goal will be to get everything leased up to at least 95%, and then if we do have any concessions, to cut the concessions and then start pushing rents. So we won't try to get any higher than that, but we'll push rents as we hit 95%. I feel like collections have been really strong, so I don't see any difference going forward unless something really happens and we have to shut down again. Or there's a lot of layoffs. But I did hear even this morning that unemployment is half as much as it was when it first hit in April. So that's a good sign for Minnesota. So we're back on the mend. So I'm feeling pretty good about where our collections are.
Yeah, that's great. I had heard the same thing. Jamie, could you speak a bit to, as we're getting all this data from our prospects and our renters coming through, how do you think the demographics are going to change? How do you think their demand for certain unit types are going to change as we progress forward?
Well, I think in the short term, so what we're seeing in Uptown, so kind of the mid-range Class A, B projects that are in the heart of Uptown, really fun neighborhoods, what we're seeing actually is an odd shift into a younger demographic because the pricing is a little bit lower. So kids right out of college can afford to live in a cool apartment in a cool neighborhood. So we're seeing a little bit of a shift there. I think the really interesting shift for us right now has been typically, 2 bedrooms are kind of the bane of our existence in Minneapolis, right? You have to find the right resident for that. And the smaller units, we're always able to fill them. We get great rents. But right now, our available unit mix, my ops team is telling me that 29% of them are 2 bedrooms, but 71% are 0 to 1 bedroom units. So just a really big shift for us, which has been very interesting. So what we're seeing is we're seeing people move home, and we're seeing people either, if they can afford to move into a 2 bedroom, to have the work from home space, or they're getting roommates. We have quite a few people moving into 2 bedrooms with a roommate. So that's been an interesting shift for us. I think we're very hopeful too, and we believe that the core of Minneapolis, so downtown and uptown, in the coming months, I believe, next year, towards the end of next year, we really think it's going to shift back. Those are great neighborhoods. They're vibrant. People want to live there. I just think right now with some of the social unrest and, I think Annie alluded to this earlier, just a knee-jerk reaction to some of that. So we're seeing some people move out, but I think they're going to move back in.
So one of the big components that we're certainly watching is that unit mix, but also what amenities they're finding of more value today. One of the amenities that we've seen on our end, and I'm going to pass it off to the group here, has been certainly the gas grills. I mean, when you only have 2 gas grills and there's more demand for being outside during the summer months and less availability of those gas grills, that's an amenity that we're considering more for the future within our buildings, both for the private use on your own balconies, but also for the common areas to put a few more gas grills out there. But as you guys kind of look at your amenity usage right now and really look forward to what's going to be of value, I guess 2 things. 1, amenity spaces, and then 2, work from home. Putting more common area work from home space or more units designed for work from home. Because we are seeing a shift, and I think whether that ends up being 10 or 20% of the population that does set up these work from home offices, I think most people will go back to work to their office, but certainly on the multifamily side, we're seeing the same thing you are, which is more demand for 2-bedroom units for various reasons. And we're starting to make modifications to both our existing buildings and our marketing material, but also our future developments. So I'll pass it off to you, Todd.
Sure. I would say what I've seen the biggest uptick is on all of our rooftops. We usually have raised level gardens, and they look awesome this year. Like everybody has like their own little piece, and their tomatoes and all their different herbs and spices. Like they look awesome. Like I want to go like grab a tomato off of the some of these gardens that I've been seeing lately when I'm out touring the property. So those have been really great this year, and I think it's good for the residents to go out and see something growing instead of focusing on everything that's going on COVID. And then our pools, I would say our pools, not are people really in them, but when I'm out at the properties, they're out in the lounge chairs and on their computers and, underneath the umbrellas and just enjoying outside. So that's what I would say is noticed the most. I do see people in the fitness centers, but not as much, but I do see people that you normally wouldn't see because they are working from home. You'll see them on the treadmill, at noon, so it's fun.
I don't think we've seen a major shift in amenity use. Obviously, we have limited capacity, but the first couple weekends we had our pools open, everyone was at the pool still. So I think that we've always tried to provide in our common area spaces remote working. So some spaces for that. So we're seeing an increased use in that. I do think that it makes sense I think people are looking for bigger units, and I think that that's going to be a continuing trend. I don't know that means we should, build a bunch of 1+ dens because nobody wants those. But, I think having some space within your unit to be able to work will be important going forward. But I really do think that, particularly in our Minneapolis projects, those amenities continue to be really important to people. So when people feel safer to gather in bigger groups, I think you'll see everyone come back to the pools, the club rooms, the fitness centers. I think you'll see that again.
With us being 100% affordable developers, we don't really have any direct plans to change our amenity spaces. I think over the coming years, we may see a shift to more larger media centers, larger places for people to work from home, but, we're not putting in rooftop decks or pools or anything like that. So it's a pretty limited list to start with.
Thank you. So we've got about 5 minutes left, so I'll pose one final question. Over the next 12 months here and on the go forward beyond that, as we look way out to the future, what do you see as kind of some of the biggest opportunities to improve operations long-term as we move through this period? Certainly for us, it's been how we communicate to our customers and adding additional means of communication to give them more options. We've really enhanced our active building platforms through our software to give them a better experience with different groups they can sign up for, and we've seen a lot more activity with that. But communication's been really a key for us to over communicate to an extent regarding a lot of subjects, whether that be the stimulus bill or other things that could directly impact our customers during this period. So the communication pathways we're setting up, I mean, we want the in-person experience to come back where they can sit down with our manager face to face with no shield in front of us, but that shield could be there for a long time. I think some of the things that we put in place at the properties could be there for a long time. So it's been very important to us to really further enhance our ability to communicate to our customers and make sure they have access to us 24/7, 365. And I think they do have substantially easier access to us now than even a year ago because of the immediate improvements we put in place because of COVID.
You know, one thing I've been talking to staff about is, you know, being there for people during this time so they remember us, you know, after this time. You know, so it's not just we build that relationship and they do want to stay with us long term. The other thing I would say is we've been pushing really hard to partner with our vendors. You know, one of the big pushes we did in April was go out and talk to 50% of all of our vendors and said, hey, you know what, I don't know what you can do. You're going through this with us too, but Google, you know, can we spend the same amount of money with you and get twice as much, you know, presence out on the web? You know, we went to our, you know, people that put our mats in our building and said, hey, you know, can we, you know, either reduce how many you put in or can we cut the price? So we did that for, you know, 50% of all of our vendors, and it was myself and Jeff Cook, he was here in the room. And because we didn't want to put it back on the staff too. So what could we take on as leadership too and not put it just on staff? And so we got a great response, and a lot of the vendors are like, hey, you know, we don't know what you can do, but we will do something. And it's like, you know, you guys, we've partnered with you for a long time, so we need to lean on you now too. So that's been really huge too. And so, I mean, we'll stay with them for a long time. We'll remember all the vendors that took care of us during these times too.
To echo, I think communication is so key with residents, and we've gotten so much better at it because there's so much more information to provide. And so I think that's going to be key going forward. We've also, I think the push for technology has been really interesting for us as a company in trying to find efficiencies and ways to make things easy for renters. I know our demographic has really appreciated that, so we'll continue with that. And I do think that one of the biggest challenges we're going to face in the short term will be school closures with employees. Our demographic, less family, so our renter pool is less, like we won't have those constraints as much, but we do have, you know, 100 people that work for us, and many of them have school-age children. So I think one thing that we have gotten really good at is almost over communication with our team members. So, you know, like in the beginning, we were doing daily phone calls with everyone. But I think continuing with that and surveying our employees, getting in front of them, I think is going to be really key in keeping these buildings operational and keeping turnover low.
Yep, I would agree with Jamie that the IT aspect of our jobs is going to continue to be more and more important in making our residents and our you know, on-site staff lives as easy as possible. Creating a sense of safety, you know, for our tenants, make sure that they see the stickers on the floor and, you know, antimicrobial things like that around the office. And then creating a sense of community, I think, is going to be important because people are, you know, in their apartments, you know, working from home, and they want to still feel that bond with their neighbors. And so doing virtual events and you know, acting more like things are back to normal, I think is going to be important going forward. And then lastly, I do think that there's going to be a difficulty in leasing here coming up, getting people to leave their, you know, current apartments or come to your apartment if you're doing a lease up. So, you know, people are going to stay safe and, you know, want to stay at home. And so getting creative, thinking outside the box from a leasing perspective, I think is going to become very important over the coming year, and using whatever tools necessary to get people to come into your buildings.
Thank you. So we would like to open it up to questions. Anyone have any questions for the panel here regarding operations, leasing, technology, all this amazing stuff? Well, as you heard, I think multifamily housing operations is largely performing well compared to expectations when we went into mid-March and really began to make these modifications. There certainly was a lot of concern out there about how operations would be impacted. As we head into the fourth quarter, there's certainly still a level of concern, but I think multifamily housing operations just due to the ability to, through reduced turnover, reduce expenses, and be able to maintain your NOI. I mean, that's largely what we've seen across the industries and maintaining or growing of NOI still through this period, even during a period where we've had little to no to negative rent growth. We've been able to really move our way through this and make enhancements long term. So it's exciting, I think, to be a part of the Twin Cities industry group that really collaborates well together and shares a lot of good information. It's helped us a lot, our company a lot, make our way through this. I'd like to thank each of you for joining me today. Thank you all.
All right. Thanks, guys. Thanks, Chris. Appreciate it. Awesome panel again. All right. So on to our final panel today. This is our developer panel. Moderating the panel is Dave Higgins, Vice President with McGuff Development. And we do have a couple of our speakers are joining us today virtually. So you can see Brent Webb coming online here. And we have Katie is also going to be joining us virtually as well too. So David, where are you? I know I saw you out. Oh, there you are. There you come. All right. So please join me in welcoming Dave Higgins, Vice President, McGuff Development. Dave, it's all yours.
Thanks, Jeff, and thanks for everybody in attendance here, braving COVID in person, and everybody who's online. I just want to go ahead and introduce the panel, and once we're all seated, we can do introductions. Online, we've got Katie Arnold from Schaefer Richardson, Chris Osmundson as well. Actually, Chris is here. Brent Webb from Mortensen, Kent Roars to my left, Tony Kuchel from Doran, and again, Chris Osmundson from Atlantis. It's the last session, and obviously the last session captures a little recap of what other people have talked about. This is a new and unusual time that hopefully we never see again, but folks are learning a lot of the same lessons and doing a lot of the same guessing games. So I did want to start out with a brief introduction for each of the panelists. Katie, if you'd like to go ahead first.
Sure. Can you hear me okay, David?
Yeah, just fine.
Okay, great. So my name is Katie Anthony. I'm the Director of Development at Schaefer Richardson. We are a vertically integrated real estate developer located in the North Loop.
And Brent?
Good afternoon, everybody. My name is Brent Webb with Mortensen. Sorry that I can't be in there in person and at a facility that we actually delivered a few years ago. I know you kind of heard about Mortensen when Nate Podrat spoke, but my focus really is Minnesota, Dakotas, and Iowa, multifamily, hospitality, obviously not right now during COVID, medical office, but excited for the discussion today. Thanks for having me.
Thanks, Brent. Chris Osmundson.
Thanks for joining us. My name is Chris Osmundson. I'm the Director of Development with Lattice. We're just a smaller development company located in downtown Minneapolis that primarily focuses on the Twin Cities and Rochester, depending on if that's within the Twin Cities or not. And I think, right now we're solely focused on housing, obviously.
Tony?
All right. Good morning. Tony Keekley, President of Development for Doran Companies. We're a Bloomington-based company, vertically integrated with architectural, construction, and development services, and then also have offices in Denver.
And Ken?
Ken Roars here. Work at Roars Companies, which is our development arm, and then Core Living, which is our management team. We're located in Minnetonka. We primarily focus in the Midwest. So We've been around for 9 years, and we've done 41 projects, and we raise our own equity with retail investors.
As I said at the outset, this is obviously the first time probably anybody in their career, unless somebody worked internationally in Asia several years ago, has faced a pandemic and thought about how it affects your industry and faced impacts and how we've addressed that. Our first question is sort of a global question about the overall impacts on development and construction. And I thought a good place to start would be with Brent Webb with Mortenson. Obviously, they have both development and construction, as well as sort of a multi-market approach. Brent, could you speak to this for a few minutes?
Absolutely. I'll probably start with construction. So as Nate Podratz mentioned, we have 13 offices across the country. And interestingly, one of our offices is in Kirkland, Washington. So we were impacted as an organization pretty early with COVID. And I think the benefit for that was we were actually able to implement a lot of strategies around safety, specifically on the job sites. So I think the benefit of that is we've been able to be proactive on and also implement systems all across the country because we were kind of impacted so early on. As it relates to just general pipeline for construction and development, I think everybody, and as was mentioned today, there's been a handful of cancellations, but I think if anything, it's just been mostly things on pause. And then as it relates to, I'd say efficiency or labor, obviously that's been impacted on the job sites to maintain social distancing. But I think in general, a lot of the construction activity that we currently have active right now is maintain their schedules and have been on track. I think what's probably most relevant and what people are most interested in is what's the impact on cost. And we've seen some relief on cost right now, specifically for materials, but I'd say not as much as I guess I would hope as a developer. But I think, again, material costs are definitely coming down and, just costs in general as it relates to escalation have also decreased. Development activity still remains strong. I think we're trying to be creative and proactive in this current environment. Obviously, since we're not just doing multifamily, we can kind of shift our focus to different asset classes, but multifamily is an asset class that we're seeing as something that we're going to ride out of this recession as well as others, specifically industrial. But we're excited about multifamily and how we're looking at being creative to deploy different strategies, mainly a shift to potential suburbs. But that's kind of what we're seeing right now nationally for Mortenson.
That's helpful. Thank you. Tony, I jumped to you just because of the diversification of Doran and being able to see firsthand in-house kind of both sides.
Yeah, I think construction's kind of a mixed bag for us. I think the tough part is kind of sequencing projects. I think our later stage projects are probably getting more affected by COVID than our earlier projects. Traditionally we'll have our MEP and electrical guys on the same floor as we work to finish out a stick frame building from the top to the bottom. And now they actually have to be, MEP on one floor, electrical on one floor. Hopefully they're in sync, switch floors. We've lost some efficiencies there. If someone goes home from a job site sick, you have to close down the job site, clean the job site, wait for their COVID test to return. That can be up to 3 days for that to happen. Early on, we saw prices moderate. Let me jump back to, and I think on the flip side of this, as projects got put on pause, there was actually an availability of labor. And so I actually have one project going on in Maple Grove where we've picked up a month and a half because we had 3 mason crews on board. We had 2 precast crews on board, and now the framing crews followed up with some extra work has helped as well. So as it relates to pricing, yeah, I would say pricing was down about 2% early on in COVID. And that's changed dramatically in both here and in our Colorado office. Green treated lumber's up 70%. Green treated, fire treated lumber's up 70%. And they attribute that to home improvement projects going on, which then now has actually pushed up the cost of lumber as more green treated factories actually pull most of that lumber supply to try to replenish that. It's actually pushed up the cost of the cost of lumber packages. And I think the one that everyone told us was never going to be an issue, as of last week, it's hard to get appliances. Literally really hard to get refrigerators, and I'm not sure why. I think it's a supply chain issue, but refrigerators are really scarce right now.
Just to sort of echo the experience and bridging development construction at McGough, the development company just opened up in May a 402 unit apartment in Bloomington. And I think I'd like to sort of use that as a little bit of a case study and ask a question of Chris and Ken and Katie is really a question. Did you have an experience where you had to really pivot? A sudden moment, obviously, again, this is a really unique circumstance. Out at our Fenley project, we found that partnerships and communication, like the last panel was talking about, were really key. We realized that we were at about 97% on our first phase, and we really needed to leverage the partnership that we had with the city of Bloomington. Great relationship there. They were super helpful. We realized that we had an opening coming and met with them, said, look, we'd really like to work to accelerate our first temporary CO. They came to the table, super helpful. The partnerships in the subcontract community were absolutely critical to making that happen, and we were actually able to accelerate by about 3 weeks the delivery of our first phase. So I'm just curious how you guys have experienced that. Maybe Chris, do you have a key sort of COVID war story that or key pivot moment where you did something really different you didn't anticipate?
Yeah, I have actually a personal one because I moved into a project that Opus was completing, and they were shuffling refrigerators around, to Tony's point. So about half of the units when we moved in didn't have refrigerators, and we did, so that was lucky. So we've seen the same kind of, I think it's generally like supply chain shortages. As Tony mentioned, labor had mediated kind of it had receded a little bit in terms of the demand that everyone was seeing. I think it was something like 12 to 15% of projects had fallen off, but they were something sometime out in a given period, either 12 to 18 months out. So it just kind of depended on, as Tony had said, where your project was fitting into those timelines. I do have an actual project though that we did pivot on. Our project in Rochester is a 350 unit mixed use site. It's got commercial, hotel, multifamily, tons of parking, and we opened that up, right into COVID. So I think we opened in, I think we got our first phase CO mid-March, and then they've been kind of tiering as we've gone. I wouldn't recommend anyone else to do this, but Rochester is a fairly unique market. We actually transitioned short-term furnished units into a hotel in Rochester because Rochester is so unique that once their capacity had come back up from a hospital perspective, they had furloughed workers. But as of mid-May to the beginning of June, they had actually ramped up their capacity back to 80%. So we've opened up the hotel component with a management company that's dissimilar from the multifamily company, and really pivoted that to a full service offering. And why we did that was because we were a brand new facility, so people could come in and essentially be the first people in the rooms, and cleanliness was a big factor for a lot of people. And we had UV filtered treatments, and we could discuss those qualities of a new build. So as of last night, I think we were realizing ADRs of $150. We were up at 30% occupied, which is literally 3x what downtown Minneapolis is right now. And the rest of the hotels, I mean, we're just introducing our concept, but the rest of the hotels are about 60% down there. So that was kind of a a very strange pivot. Like I said, would not recommend that probably for anyone else, but that has been one instance where we actually offloaded our multifamily risk a little bit by pushing it into a hospitality realm. And multifamily leasing has been going surprisingly well, but that's one economy that's fairly resilient right now. So so it was a strange pivot, but it was a quick pivot and it worked.
Thanks. Katie, do you have your own experience where Schaefer sort of found themselves a little flat-footed, but you made an adjustment and it had real impact?
Yeah, and not quite as dramatic as what Chris talked about, but I think one of the words for 2020 will be pivot, and another will be problem solving. So every step along the way, every day, every week, there's something new that comes up, and a new way that we need to be thinking about how to handle things. So for us, we haven't had any projects open since COVID started. We had a few that were further along in lease up, and we have a few that are opening later this year and early next year. But for our construction projects, trying to figure out what the liability is, what was our role in terms of requirements on the site as construction remained an essential service throughout the whole pandemic. We have a project where I think almost all of our projects have had a case where an employee has tested positive for COVID, and what to do in those situations, I think, has been kind of an unknown. And so, when do you take action as an owner, and when do you kind of let the systems take the process? And we had a site where we did have a couple of positive COVID cases that came back, and we ended up shutting down the project for a period of time, cleaning the building, kind of investigating what happened. And it was pretty early on, so I think became a good learning experience, not just for us, but for other developers and contractors as well. Trying to figure out where we could improve our practices in terms of health and safety and wellness, making sure that contractors are following best practices in terms of spacing out on break time. Tony talked a little bit about trades in different areas, and so instead of concentrating a lot of work in areas, really being deliberate about where people are working, so that if there is a trade that where there's a positive case, you can kind of isolate that trade, remove them from a site for a period of time, but the others can continue on. So certainly some best practices and some different ways of thinking about our projects. And I think as we go forward and we're looking at development projects that are starting construction, anticipating that construction will last longer than our schedules will be extended over what we've been seeing. As we need to, if critical paths are interrupted, or if we need to shut down the site, or as we're playing the game of whack-a-mole with the supply chain, it seems like every few weeks it's a different trade. So it's cabinets or counters, or now we're dealing with appliances and even finding supply of lumber, not just the pricing, but actually getting the lumber on site. So continual communication and partnerships in a way that we haven't. We've always had good relationships, but really needing to come to the table and have everybody come to the table with the information we have to make the best decisions we can in a time where there's just a lot of unknown.
Thanks, Katie. Kent, I'm actually going to pivot to our next question with you to the topic of design changes and what do you see as prominent changes? But also a little bit of a two-part question. What of those changes do you think are probably a short-term response? And what are the ones that maybe are going to stick longer term?
Yeah, great question. Before I answer that, hey, Jeff, do you have that picture that I sent to you? Awesome. So this is to go to the point on lumber. I just think a picture can mean 1,000 words. So I pulled this up in advance of the presentation today, and what it's showing is lumber pricing over the last year. And we all hear, I think, anecdotally how much lumber has gone up or the supply of it. But the opportunity to see the picture there is just absolutely unbelievable. And so that is affecting, as some of the folks mentioned, the pricing of our projects going forward and just sheerly getting that product on the site. For the question that David answered in regards to the changes that are being made out there, it's a good question. I mean, first off, the question of what's going to stick or not is, I think, up for debate. What we've noticed, though, is as we're taking a look at these new projects is really the quality of the outdoor amenities. So, trying to reduce that resident isolation. So I don't know that we're making the spaces any bigger, but maybe they're more in focal point in what we spend time on, and maybe a little bit more money spent in that area versus others. We're also seeing requests and wants for having walking paths and trails that kind of create a loop around the buildings. The architects are pushing this idea of maybe outside or outdoor fitness equipment, since natural UV light kills viruses on surface handles. I think that is more temporary. So that's why we're not doing it. We are also getting a request from the residents for more office, business center, Wi-Fi, lounge type spaces to do their Zoom calls and stuff outside of their units. Bigger demand for the 1+ bedroom dens, so people can have dedicated workspace. And then janitorial space that's closer to our very used amenities like workout facilities and community rooms and public restrooms and so on. Chris had kind of mentioned the HVAC. There is talk about upgrades. Again, I don't know that we've made any big changes there because most units are on their own already for all their purposes there. I think there has been, and I think what may be longer term is really the surface transmission touch points. So it's taking a look at the automatic door openers in very used door spaces that we maybe previously had not. That adds some expenses. But even just the small things like the foot pull door openers on the public restrooms and common areas that previously would have been fobbed or closed now have magnetic door openers holding them open, and reduce time at the common area amenity spaces, and maybe taking a look at non-porous surfaces in common areas, like a quartz versus a granite. And I think it's becoming common is to have eliminate concierge desks and those types of surfaces. So I think some of it is driven quickly to make happen by the short term, but I think longer term, some of it's going to hold.
Thanks, Ken. Chris, how about yourself? Any key design changes that are longer term in your mind that are really sort of discovered out of this time period?
Yeah, I think the earlier panel was talking a lot about kind of technological improvements that we can make at the sites, and you kind of see the whole spectrum. I think the adoption of a lot of the touchless technology. So we've used a system called Latch at 2 of our facilities where you basically use your phone, and if you don't have a phone or you're of a generation that doesn't want to use a phone, you can actually use a hard PIN code. That piece there's actually a security camera in it, so it can help you with all of your shipping needs, or if like you've got a rover that's coming to take your dog. But you can actually access your front door without even grabbing the handle, because when the access code is input, you can basically just put your shoulder into the door as opposed to grab the door handle. So that's one way for user entry systems, and you can put those at community area spaces, and it's a little bit niftier than just kind of the floor entry system. It also helps with your packaging needs. I also think that's more of a long-term shift. In terms of short-term shifts, I think one thing we've debated is kind of as Kent mentioned, the difference between providing people really in work, kind of in-unit work facilities versus actually just making the amenity spaces that we so often kind of decorate with really a lot of seating options as to be more, work friendly. So a lot of times you can buy, FF&E that has, acoustical components, so that if you're a really loud talker like I am on the phone, that conversation is at least contained in kind of an egg pod of a chair. Or you can do, the specific work from homes. Nowadays you can add really nice systems that are are basically, similar like what you see at a hotel and hospitality, where, you can tell when a certain area is booked. Right now, what we're seeing, I'm seeing at the building that I live in, and what we're seeing in Rochester and Ironwood and our Latitude project is, we typically are only designing 3 or 4, well, 2 to 3 actually kind of work from home spaces. And if you're not down there by like 7 or 7:30 a.m., they're totally booked, and that is now someone's space. And so it's great that they're desirable, but that person is essentially occupying that space for as long as they want to. And so going forward, we need to make sure that people can book that time either for a conference call or, that they can only get 90 minutes or, 120 minutes. So I think that's a long-term change just in terms of, really making these spaces efficient. But I like going to a 1-bedroom den and all of a sudden creating a unit mix that's got 30% 1-bedroom dens would scare me, because typically the pricing distinction between a 1-bedroom and a 2-bedroom, there's enough of a disparity there. Whereas 1-bedroom dens typically, maybe there's a $50-$100 delta. And so someone will just go into a 2-bedroom. So having more space is becoming common. I don't know how long that's going to last again, as people, are paying their chunk rent. If they're starting to go back to work and just spend more time in their working facilities, I think they'll revert a little bit. But I think you will see more 2-bedrooms being designed rather than 2-bedroom splits that contemplate roommates. You'll see more, I think more 2-bedroom, but the convertibility of that 2nd bedroom into more of a, as the millennials get older, into the potential to be a room for the first child, could also be an office space. It just needs to be a little bit of everything. So I see the split kind of going away, and I don't know, kind of a 2-bedroom but convertible office space coming a little bit more prominent.
Katie, what are you guys seeing at Schaefer Richardson when you're thinking about design in this new climate?
Yeah, I think I keep coming back to that we're still pretty early in this, and our development projects are such a long time horizon that, what design changes are we making that are going to be long-standing? And I would echo what Chris was saying in terms of having that in-unit space. We're looking at our amenity spaces, and kind of we've been trending towards bigger amenity spaces and more open, and kind of whatever the hot new thing is. And trying to find those niches where people can get away for the work call or, the work from home. And I think that is the work from home trend will stay with us even as people go back to work. So trying to do that with our amenity spaces. We've been trending on our urban projects towards smaller units, studios, and even micro units. And it's a little bit early to see where that trend moves. But certainly my feeling is that when you're in 400 square feet of space and you're in it all the time, that gets pretty unmanageable at some point. But I think those flexible spaces is key. We haven't been doing many 2-bedroom units in urban areas lately. Even in our suburban projects, we aren't doing that as much. There's just hasn't been the demand for it. So how do you kind of provide that space without running into in the future an inability to lease it? So I think that having the 1+ and the plus can be flexible space is kind of the direction that we're moving in addition to providing those spaces outside of the apartment where people can do their work, take the call, get away from their family for a little bit, whatever the case is.
That's helpful. Thanks. Tony, Doran, generally speaking, and sometimes in commentary, has, let's just say, increased its suburban focus. As you've done that there's naturally units tend to get larger, but how have you guys looked at your new projects, not only in saying, okay, if we're even more suburbanized, units are going to get larger, but how does COVID relate to what you're doing between units and amenities?
Well, I would, excuse me, first I would echo what everyone's kind of set up here. I think the big change that we'll make even in suburban projects is there are going to be more people working from home. And it's been real interesting watching that. It's not necessarily the private space that people want, it's the public space because they actually want public interaction. So I think we'll have greater amenity areas with more areas that you can work from both indoors and outdoors. But as people are starved for public interaction, that's kind of where they want to work, I would say. We've taken we like the larger unit, and I would say we even like that we still do a lot of large units in our urban locations. Our big cohort has always been that empty nester, and we're 40% in our lowest project and 60% in our highest project of empty nesters. And I think we'll actually see that trend grow as they try to elect to capitalize on what's going on in the single family home market right now as well. So I think it's a model that's proved us well. We have done, I can say, probably less than 20 studios in the 5,000 units I've done in the last couple of years. That's not something, I think, as someone indicated, in an area, in a time like this, does somebody really want to be in 400 square feet? And how long do you want to be in 400 square feet? And every time you turn a unit, it costs money. So I think between that and really in some of our public spaces, having the ability to, within our community rooms, subdivide it into 2 or 3 spaces as maybe another pandemic comes. Just looking at this, in the last probably 12 years, we had SARS, we had MERS, and now we have COVID. So this has been around. This is just the first one that's affected us. And I think we're probably more highly susceptible to have it happen to us again.
Thanks, Tony. Brent, it'd be a good counterpoint, especially given more of the urban projects that you guys are focused on. How are you responding to maybe what tends to be a more younger millennial type population that is more and more in the last 5 years interested and open to smaller and smaller units? How are you setting that against today's climate? Design.
I think it's similar to what other people have said. I think it's trying to be in tune to the amenities that are going to be, I guess, resonating with what those demands are. I mean, I think, the outdoor spaces are going to be important. I think we found a lot of success with our work from home space at Rafter. And as we started opening amenities back up, obviously at reduced capacities, they are getting used even more so than before. And I think that's going to be something that's going to stick. But I think, one of the shifts that hasn't been mentioned yet that I think everybody's in tune with is that, everybody's purchasing things more so online than they ever have been. And I don't foresee that shift going back as much. Once you start getting used to ordering everything from Amazon to your groceries online, it's just so convenient. So, it was already something that we were tracking and trying to be responsive to and proactive with in our new projects on how to manage the storage to accommodate all the increase of groceries or even having cold storage within your building to accommodate grocery deliveries. But I think that's going to be a constraint that we're going to see in the future is how do you actually accommodate that much storage space? But that's probably something that we're probably tracking the most right now.
That's helpful. Moving on to the next topic, I'd ask Tony to start out and speak to really within construction, what do you see as changes that are actually going to be a long-term shift, maybe a permanent shift in the apartment space?
Construction, that's kind of hard for me to answer. I know we've always kind of adapted to early construction techniques, from panelizations to having a unit actually completely wired in a box so it's easier to pull wire and things like that. I think we may see there's other technologies that you see throughout the country. Lake Gauge steel, it's been done here a couple times. It's very prevalent in Denver. Really is cost effective from buildings probably 8 stories to 11 stories. We feel that concrete still is a better option at 12 stories and above. And wood, now with the new change in the IBC, being able to go to 7 stories above or 5 stories above 2 levels of concrete. That's still probably going to be the most cost effective. So I think that's probably the only trend. I think, you know, I'm intrigued by some of the, as we try to mitigate kind of costs, I'm intrigued by some of the smaller projects that are getting done with less amenities, where the neighborhood's kind of the amenity. I think that's a way to moderate construction costs, because you're not putting so much money into the amenity spaces and increasing the inefficiencies of your building.
Thanks. Katie, how about you? What are you guys seeing? I know we've talked briefly about, you know, one change you guys have turned to in one of your projects in Northeast, and I'm leading you on a topic, but or an answer. But what changes that are kind of wholesale and notable are you guys looking at? Maybe with that parking solution that you guys have there, but obviously help yourself if there are other areas where you're seeing a change that might last.
Yeah, I mean, I would say that's not a COVID-related change specifically, but maybe a refreshing to not talk about a COVID-related change for a minute. You know, I think parking parking has been part of the conversation for years in terms of where is the future of, you know, driverless cars and improvement in transit and people going away from owning cars, and so. You know, thinking about what's the right amount of space, and how do we accommodate, how do we get creative about designing our buildings so that they can be converted into other spaces. And so, you know, are we designing parking garages in a way that where the layout naturally lends itself to another use like multifamily or even office? I think you're referring to a project of ours called the M on Hennepin in Northeast, where due to other circumstances, namely construction constraints on the site, we ended up putting in a car stacking system that is a matrix where an individual can drive into their parking spot, and then a machine kind of takes their car, moves it up, down, to side, in a way where you can have 2 cars or even 3 cars in some cases in one parking stall worth of space. And it's worked. There's been a learning curve for us on that front, but it has worked. And you know, it allowed us to provide what the market is demanding for parking in that location right now, where, you know, without it, the question is, you know, could we lease that space? So, you know, I think long-term construction trends, I think using technology, generally speaking, to think about different ways of how we not just build buildings, but operate buildings will continue to be a trend. And, you know, I think even how we're doing leasing walkthroughs or construction meetings and kind of these using technology in a way where it's not about showing up at the trailer, you know, sitting there and talking to each other face to face, but, you know, providing, you know, video walkthroughs, drone imagery, you know, just using those technologies to maybe even help us move, getting back to the parking piece and the car piece, move away from needing to physically be in a space at any given time. So I think I'm certainly not an expert on construction and what direction it will be moving, but we're always looking to solve problems in different ways.
Thank you. And the one tie-in I would make to parking and the challenges there, and you know, out at Bloomington Central Station where we have our Fenley project, we're right on the light rail. There's 3 different stops that serve Bloomington Central Station. We see it as a huge amenity, a huge asset, and part of the discussion with the city throughout our entitlement process is really what's the right parking ratio. Well, in the pandemic climate, there, you know, I think there is an inclination for people who either were partial public transit users to get back to single use vehicles. And I think from a policy standpoint, I think some communities may have a little pushback one way or another based on how many people, you know, how long this pandemic lasts, how many people are more inclined to stay in the car. And then the demand is on the development community to say, well, we only have so much space. there are fewer and fewer development sites, at least in the core, and progressively less in the suburbs. How do we achieve that on our site? And maybe one of these solutions is something there. Brent, can you bring some sort of multi-market perspective to what you guys are seeing at Mortenson across the markets you guys are in? That might be.
Yeah, I think it's pretty consistent to what Tony said. Mortenson's a type 1 builder, and so we've typically just been building in the urban core, but I think we're always trying to figure out ways to obviously evaluate costs and having the location amenity as the amenity instead of delivering tons of amenities. Also focusing on locations that are not urban is probably the biggest shift that we're doing. And also doing smaller projects. I mean, a lot of the things that we've delivered have been, 20 stories and above, but now we're evaluating doing, 150, 250 unit projects in the first ring suburb areas throughout the country, and trying to leverage a new build type. And I'd say more to come on that, but we have a few projects in the pipeline that we're doing just that right now. Kind of less amenities, potentially more depending on the location, but again, smaller in size.
Thank you. Kent, you hit on some of this with the design, but what are you guys at Roar seeing in terms of construction trends that are beyond design methodologies that are helping your projects and you think might stick longer term?
Yeah, I would say one of the interesting parts we had was on the War Stories part was we opened up 2 buildings this past spring, one April 1st. And one April 15th. And the April 1st project was in Northeast. It was 60% full, and it was 95% within 3 months. The one in Burnsville was actually 60% pre-leased. And there we had some contractors getting COVID the week before we moved in, and we had contractors pulling off the site. And so we as owners were on the phones, making certain they're going to be back on Monday because the project opened on Thursday. And we were able to do that. What was interesting there was that the people that pulled off the site said they were going to be back on Monday. Of course, we were worried about that. And what we found out was their major reason for pulling off site was that all their workers were driving to the job sites together. And so they had to get everybody to drive in separate cars because they were from the St. Cloud area. And then instead of 2 people staying in a hotel room, only 1 person could stay in. So it was more of a logistics issue for them. But we have started to run into some problems at some of our sites with having enough parking now for the contractors, just because everybody's showing up with 1 person per vehicle. So that's been something that we've noticed and have had to adjust to and work through lately.
Thanks. Playing off the comment from Tony about kind of the wired in a box. Chris, you guys have a project where you're actually talking about the box over in St. Paul as a wholesale change in kind of construction in a really significant way, and you guys are early to the game with that. Can you speak to that project? And
Yeah, I can. I mean, and so that was kind of a pre COVID change as well. But we are, I think everyone's probably looking, or at least kicking the tires on, modular construction and what are the benefits. There's clearly a timeline benefit, but there's a brain damage cost. We're not sure where things will shake out in terms of, being able to get equity and lenders on board. You need builders with track records. Does it actually result in a material reduction of costs? If it doesn't, are the intangible components of a lot of those things I just discussed, are they actually just more expensive in terms of capital that you're using and overhead that you're expending? So we're definitely working through it. I think it has its place, especially in trying to realize kind of the missing middle income type of product. And also, especially as, really we've seen the low income housing tax credit types of properties essentially be oversubscribed from a bonding standpoint in essentially any municipality that you're working in, whether you're able to go to the county, city, or frankly state. And so it's a way to hopefully promote some form of affordable housing without subsidy. And I mean, if you know anything about, low income, typically the TDC, on a per unit basis is somewhere very equivalent to or even higher than probably your standard market rate project, mainly because, your hard costs are about the same, but actually the rest of your, kind of soft costs, financing costs just tend to creep up. So yeah, we're definitely exploring that. I think just on that though, a little bit and related to the parking discussion is it's going to be interesting in urban areas because right now, I think the anticipation is that people are going to be coming back to the office at some point in time. But I think in particular, St. Paul and Minneapolis, they have quite an existing parking infrastructure. And so one thing that's getting hard to model is, going forward, if your office building that had, some percentage of parkers coming in from the suburbs, now that's 70% of that, your parking rates are going to be dwindling no matter what. I mean, you're just going to have less parkers in those facilities. And that makes it a lot harder for parking to be accretive at all to any project. And so I think it'll be interesting as the suburban projects like Kent is talking about, you are going to have more people driving. So I think your parking rates are actually going to go up. But in downtown Minneapolis, where you were seeing $130, $95, even 200 plus, you're not going to be able to charge that anymore because someone's going to be able to go to the ramp next door and pay $50 to be in that facility. And I think, whether developers like it or not, and frankly, residents like it or not, without, tax increment financing or some form of subsidy, you're not going to be able to build parking. It absolutely won't pencil. And we're seeing that a little bit with this modular construction project that we're looking at. It's along the light rail, but I'm expecting that we're going to be able to charge like maybe $50 for parking. And if you know anything about the economics, an underground parking stall is anywhere from $25,000 to $30,000. Cap it out at 7% doesn't work. I mean, it's essentially it's going to ruin your pro forma. So that's a big potentially long-term change that probably is just expediting something that was maybe going to happen, but it's going to be a reality here moving forward. And so anything we can do to decrease our costs, from just what's going up over the podium is going to be beneficial so that there is some parking. But it's, seeing 1.4 to 1.6 ratios in downtown Minneapolis, I think is going to be very, very tough.
Chris, I'm going to stay on you with the next question and
Perfect.
Yeah. And, you are looking at the Rise Modular and you are obviously speaking to some of these challenges around parking. Do the combination of those factors and some of that creativity have you looking in different spots? I mean, you guys are obviously down in Rochester. It's a different animal than the Twin Cities, but you're also doing, first ring projects around. Where are you seeing the new development opportunities? And I mean, I don't think most of the folks on the panel aren't really doing any value add, but are folks starting to look at, geez, these projects requiring to do parking, I don't know what the next 5 years is. Are you starting to look at some existing
Sure.
value add?
Yeah, I think there's a few factors that have gone in to help the story with respects to ground up development, and have, maybe hurt the story with respects to ag rehab. I mean, one, if you see a flyer for a distressed asset, quote unquote, typically that means, the cap rate that it's going to trade at is like 4.75%, which probably means that, at the end of the day, they've either already priced in what you're going to be able to fix that distressed asset up to, or it's just kind of fluffy underwriting. But I think, for right now, distressed assets are tough to come by and truly turn a margin. Whereas I think there's a lot of things potentially going for new construction. And, one, it's a new facility. So like I said, kind of the cleanliness and just, the ability of someone to kind of rent hop. I know sort of our I think everyone up here would say their retention rates for residents are probably the highest they've ever been. I mean, 70, 80%, whereas, 50 was seen as good. If you were in affordable housing, 30 was good. So there's a little bit of that too, but I do think people that, still have their income and, especially in Class A, there wasn't a lot of, unemployment in those areas. So people are still able to hire for moving. So I think AC Rehab is going to have a little bit of a tougher time coming online. And just an interesting conversation I had with a banker 2 days ago. It's going to be interesting as we get, a year or two into this, because during the last recession, bankers were really seen as kind of the problem with the system. And so regulators threw the book at banks. They were making them write down their balance sheets. They were making them go through workouts, sell to the lowest bidder just to get it off their balance sheets. Now there's kind of like this weird sense that we're all in this together. And I don't know how many banks are going to be forced to put portfolios and properties necessarily out on the street so that, it's truly a distressed asset where you can buy the debt for, 25 cents on the dollar. So that'll be interesting. But I think also just in terms of new construction, most of us, I believe, are anticipating, inflationary pressures. I think that's both on the top line revenue and probably on the construction side. And as long as those keep pace, I think you have an opportunity to have a yield on cost and still sell at a good low residual cap rate and possibly even a larger arbitrage between those two. So the more you can spread that, the better. And so it depends what capital group you're talking to, but I think a lot of people are actually targeting, more new construction, whereas, probably for the last 3 years, it was transitioning a little bit.
Tony, I'd ask you, and recognizing that we've got about 10 minutes left, the following comments I would tighten up a little bit. But Tony, where do you guys see new development today, and are you guys looking at acquisition rehab, or where do you see the split?
We don't look at acquisition rehab really at all. Just I've never done it, so I don't know that would be something we go down. I think, I still like the multifamily market. When you look at the demographics of our biggest cohort, empty nesters, and what's going to happen over the next 12 years. So I still really like that. I think there's probably 2 or 3 markets that scare me. Downtown Minneapolis really scares me. I think just the safety perception of not actually having anyone downtown scares a lot of people. I think as you get into the neighborhoods like Northeast and the North Loop and some of the other boutique neighborhoods of Minneapolis, they're just fine. I'm going to say Uptown scares me. I've never done a project in Uptown, but given my age, I think I only know 2 people there, and neither one of them are living in Uptown. They've all moved back out in with their parents just because there is a perceived safety issue in that neighborhood. I think I'm still really bullish on Denver. If you ever look at that submarket, the amount of job growth in that submarket that fuels that market, it's mainly technology. Everyone was kind of worried about the oil and gas industry, and even more now. But that market continues to grow, and that's both suburban and urban there.
Thanks, Brent. Again, sort of the multi-market approach. Where do you guys see the opportunities, and why?
Similar to what I said before, but and kind of echoing what Tony said, we are definitely shifting a focus away from downtown Minneapolis right now. I think safety is a big concern, and actually taxes are probably the bigger concern. So we've been shifting more to the suburbs, and I'd echo also what Tony said about Denver. We're pretty active there right now, and then the other market would be Salt Lake. So we're seeing a lot of activity there, and that's likely where we're going to be seeing some of our new multi opportunities. So first ring suburbs in the Twin Cities, and then Denver, and then Salt Lake. But definitely exciting to kind of see that there's still equity interest, and also it seems like the rents are pretty stable in those markets right now.
Great, thanks. Kent, how about you?
I was going to add one other, because I think I said 3 and I only named off 2. I'm really watching the Southwest Light Rail, and I think of that as a market, as it essentially leaves Minneapolis and ends up in Eden Prairie. Just off the top of my head, you could probably build 10 to 15,000 units along that Southwest Light Rail line, and I think only the good sites are going to survive.
Fair point. Fair point. Ken, briefly.
Yeah. So I, like others, think the apartment market will be strong going forward. I am worried about the core and uptown. We don't have any projects in those areas, so we have been suburban focused. My thought though is, as we're taking a look at the charts that were handed out with the amount of units that are going to be delivered here in 2020 and 21, it's a lot of units. So I would say we as a firm have been focused here in the Midwest and liked it, but some of the names that others are referencing, we wouldn't probably mind starting to diversify in the future, because it'll be interesting to see the job growth creation here versus other parts of the U.S.
Again, given where our time is, I'm going to pivot to Katie and move to the last topic, or I think the last two topics are kind of at their core the same. Schaefer Richardson's pretty well split between urban and suburban now. You're making that move, and where do you see, if you're making a prediction on where things are headed overall for the Twin Cities, what's your 1 minute summary if this is a speed round?
Sure. Yeah. And I think I might get kicked off in about 4.5 minutes. So I'm probably okay if I disappear. I think to echo some of the same pieces, even pre-COVID, pre-2020, there's a lot of supply coming online in downtown Minneapolis, in the North Loop and Northeast. And so it was getting a little bit soft and a little bit hard to lease up buildings there already. I think for us, we don't have any downtown projects, but we do have North Loop and Northeast projects. And the main amenity in those buildings is the neighborhood itself. And so I think similar to what other people have said is when things are shut down, when the restaurants aren't there, when the retail isn't there, when you're not walking to work or taking your bike to work, some of the desire to live there and to pay the rents that are charged there goes away. And with interest rates low, and if people are able to make the move to homeownership, we are seeing some of that. I think suburban, strong first ring suburbs and even further out will remain strong. I think Equity seems interested to be in Minneapolis and the greater Minneapolis, St. Paul area. And so for a good site, I think you can get solid equity and solid debt. I think there's an opportunity for that kind of workforce housing that's maybe not competing for the tax credit bond market of the world, but if we can get construction costs down a little bit and kind of charge some of that workforce rents, not the luxury rents, I think there's a real opportunity there, both urban and suburban. And I think that probably covers. We do have 2 projects, one in the North Loop and one in a farther out suburb that will be opening in February or March of next year. And so we'll get a good head-to-head competition on a suburban versus urban lease up and see where that goes.
Thanks, Dee. Kent, again, you guys with a focus on the suburban markets, if you were to narrow your focus actually to the suburban markets, what are your predictions there? I mean, where do you get creative when so many are doing kind of the same kind of project?
Yeah,
differentiating.
I mean, the project I mentioned in Burnsville, Burnsville hadn't had any new apartments built in 16 years. So we were the first apartment open there, which is why we leased up so quickly and had it 95% in 3 months. Keith had mentioned it. We did get earnest money that went hard on that property, which is one that we're looking to sell where we'll more than double our money in an 18-month hold. So we are finding a lot of traction out in those markets. But, as we look at going forward, we've got our eyes on Blaine and we've got our eyes on Minnetonka and Maple Grove. And so, Fridley's our project we're going to do in October, which is kind of a different one. Katie had mentioned it. It's more workforce housing where we've got some TIF from the city and such to help us out in that community. But we are all about suburban, and those are just some of the communities we are looking at going after. And again, it goes after, where the growth of some of these communities are. We're starting in Lakeville this week. We started in Woodbury back in February. So we're very, very bullish on the suburbs. And again, the product for us is below the luxury. So it's that what I would call an A- type product where it's got the amenities, it's got granite, but it is the thin, cheap granite, So it's not the finished level of an A+, but it's got pretty much everything that those luxury products have.
And pivoting back to the urban perspective with Brent, Brent, I realize I'm asking you about urban, and you've made the comment that you guys are pivoting to suburban, but that's the challenge, right? Like,
Yes.
Predict for us when you pivot back. I mean, is this, everybody talks about, well, when's the vaccine coming? Oh, it's about 2 years out. And I think one thing that I know in a number of capital markets conversations that we've had in our office is the